with us their view on the priorities of the policy agenda needed to shape this financial system for the future. Now, we want you to actively engage in the debates, and we have foreseen Q&A sessions at the end of each session. Now, for this, let me share with you some housekeeping rules we want to follow in submitting questions. As of the start of each session, you have the possibility to either submit questions in writing via the chat functions in WebEx to all panelists, or, and this is preferred to make it more lively, you can raise your virtual hand and we will call up your name to ask your question in person. Once I call your name, you will be, and that's the technical term, upgraded to panelist. You will be able to switch on your video and mic, and you will have the opportunity to ask your question to the panelists. Once the question is answered, please switch off your video and mic, please lower your virtual hand, and I will call up the next name. But now, without much further ado, I turn to Vice President de Guindos for his opening remarks. The floor is yours, Mr. de Guindos.
Well, thank you very much. Good morning to everyone. I hope that you can hear me and you can see me. So it's my great pleasure to open today's conference. I'd like to use this opportunity to reflect on some important developments in financial integration that have taken place over the last 2 years and assess them from the perspective of a financial system for the future, the title of today's conference. I will begin by touching on the pandemic's implications for the financial sector in Europe. I will discuss how the progress achieved on financial integrations since the start of Economic and Monetary Union has helped to increase the resilience of the EU financial sector, before arguing that the further deepening of EMU can help tackle the current and future challenges that come our way. I will then conclude by reflecting on the economic fallout from the Russian invasion of Ukraine and the implications that could have for financial stability and financial integration. Let me first discuss the implications of the pandemic crisis. When the pandemic began, we saw a notable decrease in euro area financial integration. But thanks to fast and decisive policy action at the monetary, fiscal, and prudential levels, this deterioration not only stopped, it actually reversed relatively quickly. This is in contrast to what has typically occurred in previous crises. As the pandemic unfolded, public health measures, mobility restrictions, and production constraints limited household consumption levels. This meant that key private channels of risk sharing across euro area countries were restricted. So public risk sharing via governance became crucial for macroeconomic stabilization. Major fiscal initiatives at EU level were key to ensuring that risks were shared among member states, compensating for the fact that private financial channels were hampered. Sizable fiscal risk-sharing mechanisms were established with the next generation EU recovery package. The associated investment and reforms are expected to improve risk-sharing at the public sector level over the coming years. Joint support from fiscal and monetary policy has been indispensable in avoiding a much deeper economic downturn. For example, credit support measures such as loan guarantees proved critical in shoring up the financing of firms and households during the pandemic. At the same time, we should not overlook the decisive role played by the EU financial system in weathering the crisis, notably by being able to meet financing needs during the pandemic. The fact that the system could withstand a shock the size of the pandemic is testament to the effective implementation of ambitious financial reforms in the aftermath of the global financial crisis. But it's important to remember that it took a lot of hard work to achieve this resilience. EU financial integration has come a long way since the launch of EMU in 1992. Soon after the introduction of the euro, policymakers realized that the single currency alone was not enough to spur the further development and integration of the EU financial system. Support was needed from policies that were conducive to the free flow of financial services in the euro area, in addition to adequate legal, regulatory, and supervisory frameworks, along with greater institutional integration. There were several milestones on the road towards European financial integration, including the European Commission's Financial Services Action Plan for the harmonization of the EU financial services markets starting in 1999, the Lamfalussy architecture to improve regulatory processes introduced in 2001, the launch of the banking union in 2012, and the two subsequent action plans for the capital market unions in 2015 and 2020. Despite these achievements, there is still more work to be done. We need to push forwards and further deepen EMU. And we need to do so while keeping in mind the new challenges that we face, such as the transition to a sustainable economy. The growth of green finance can facilitate, and at the same time benefit from, the integration of EU capital markets across borders. Deeper and more efficient capital markets, with equity playing a greater role, can be instrumental in encouraging the more rapid development and adoption of new technologies, including green technologies, and in facilitating the provision of finance across the Union. Indeed, research finds that carbon-intensive industries tend to reduce emissions faster in economies with deeper stock markets. Last November, the European Commission published the Capital Market Union package containing legislative proposals and key commitments in the Capital Market Union Action Plan. This was an important step, but we need to be more ambitious in three main areas if we are to achieve a deeply integrated capital market union. First, we need to see harmonization of insolvency rules and withholding tax regimes. That will help create a more integrated financial sector that can easily operate across borders, including in green market segments. The ECB is therefore looking forward to the upcoming Commission proposals on this matter. Second, reducing the debt equity bias and harmonizing venture capital frameworks across member states are important steps to support equity and risk capital markets and thereby provide smoother financing for innovation. Third, we need to make progress on the EU sustainable finance agenda. There should be no more delays as we strive for a reliable and transparent regulatory framework. Sustainability disclosures and reliable standards for green financial products are key to reaping the benefits of a green capital market union. This is why we need the Corporate Sustainability Reporting Directive to be implemented swiftly alongside the broad adoption of a sound and usable European Green Bond standard. While Capital Market Union is a crucial pillar for EMU, we also need to see progress on other fronts. The banking union remains incomplete, but completing it is essential if we are to enhance the financial sector's resilience and further address some of its structural challenges. These include low bank profitability, growing competition from fintech companies, and the fragmentation of debt and equity markets along national lines. Completing the banking union requires efforts in two areas: improving the crisis management framework and making progress towards a European Deposit Insurance Scheme, EDIS. We very much welcome in that respect the balanced work plan proposed by the Eurogroup President, which should provide a good basis for reaching political agreement on these matters as swiftly as possible. Another element to ensuring that banks further increase their resilience is the timely and full implementation of the remaining elements of the Basel III agreement. The ECB welcomes the Commission's proposals in this respect, which will lead to a stronger prudential framework and help tackle emerging risks, such as environmental risks. Pushing ahead with these important initiatives will further strengthen Europe's resilience to future crises, allowing us to respond quickly. After all, the terrible events of the last 6 weeks have reminded us how quickly the economic environment can change. The Russian invasion of Ukraine marks a watershed moment for Europe. This is, first and foremost, a human tragedy, but the economic fallout has also reintroduced substantial elements of uncertainty just as the euro area economy is emerging from the pandemic. In the first weeks after the invasion, we saw visible implications for financial integration in the euro area, driven primarily by bond markets. Announcements of sanctions against Russia led, initially at least, to a slight divergence of sovereign and corporate bond yields across euro area countries. This caused euro area indicators of financial integration to recede, as captured, for instance, by a measure of the convergence of asset prices across the euro area. But the good news is that this indicator has partly recovered since then. And importantly, these movements were nowhere close to what we saw during the global financial crisis and at the beginning of the pandemic. For the euro area, the financial stability impact of the war has so far been relatively contained. Markets have generally been functioning well. Contrary to what happened in March 2020, there has been no dash for cash. While both banks and non-banks have been affected, especially the few that have large direct exposures to Russia and Ukraine, the economic fallout has not had a sizable impact on the EU banking or financial system as a whole. Euro area banks' initial stock price reaction suggested a much stronger impact than was implied by their exposures, which stood at less than 1% of banks' assets. This points to much greater concerns about growth and inflation and the impact of the conflict is having in amplifying them. The invasion of Ukraine also demonstrated how vulnerable Europe is due to its high dependency on fossil fuel imports from Russia. Speeding up the green transition is a key priority from this perspective too, not only to address the urgent environmental and climate challenges we face, but also to help increase our energy security and protect the EU economy from energy price spikes. Recent events have reaffirmed the importance of financial integration. First, financial integration, together with adequate regulatory and supervisory frameworks, improves the resilience of the EU economy and its financial sector. In particular, the sound capital and liquidity buffers that have helped European banks absorb shocks owe a lot to the single rulebook and European banking supervision, key elements of our banking union. Second, financial integration has improved our ability to take credible actions and has given those actions greater weight. Close collaboration in various aspects of EU financial decision-making allowed EU financial sanctions to be adapted swiftly and implemented consistently. And the ECB, for its part, is taking an active role in implementing these sanctions in its areas of competence. Let me conclude. European integration has already come a long way since the start of EMU, but we are not at the finish line just yet. Our journey is an ambitious one, and we must quicken our pace. During this troubled time for Europe, I am reminded of the words of Konrad Adenauer, the first Chancellor of West Germany. He once said, "European unity was a dream of a few people. It became a hope for many. Today is a necessity for all of us." Those words were spoken almost 70 years ago, just as the wheels of European integration were turning faster. Let us keep those wheels moving. Our current challenges call for decisive joint action from all of us as we work towards a strengthened European financial system and a solid EMU. I have no doubt that we still reach the finish line. Thank you for your attention.
Now I would turn to the audience. The audience can now submit questions, as I mentioned, via the chat function in writing or by raising their virtual hand. I turn to my colleagues. They will give me a sign once we have a first question appearing. So once more, just technically, you can submit your question in writing in the chat function, or you can raise your virtual hand in WebEx. I leave open the possibility to ask questions for 1 more minute. I think we have a quite big audience until now. 194 participants are online, if I read the information correctly. Hopefully there's one icebreaker. We received one question. The colleagues are preparing it. Apologies for this small delay. Then the first question is one that we get via the chat function, and it reads, Vice President, what role do you see for climate change in the future EU financial system?
Well, this is something that is a very, very wide question with a lot of implications. No, I think that is going to be key. No, but perhaps, you know, here in the context of financial integration, and this is something that we have indicated during my speech and as well in the action plan of the ECB that was prepared according to the strategy review. Climate change is going to be one of the elements that we will bear in mind in order to try to you know, implement and to pursue the different functions of the European Central Bank. So it's very important to take into consideration that green finance is going to be a key element. And I would like to underscore mainly the relevance that equity is going to play in order to foster green projects. Why? Because many of these projects imply long-term investments, and equity is a much better suited, let's say, source of funding than debt. So if we are able to have wider, more integrated equity markets, that will be a very important helping hand in order to try to foster green finance and you know, to implement and to pursue green investment projects in the future. So there is a clear connection in that respect. The deeper and more integrated equity markets are, the more possibilities that we have in terms of fostering green projects in the future. That will be, you know, an important helping hand in order to pursue our green transition objects in the future. So I would stress mainly the importance of equity funding and equity finance in order to try to pursue this kind of projects in the future.
Thank you, Vice President. Just to give credit to the person asking the question, it was Michael Richter who asked this question. Now let me turn to a second question we received from Miriam van der Stisselen. She asked, you did not touch on the EU's commodity derivatives market and its price setting for wheat, for instance. Is there more integration in this market needed?
Sure that this we need you know, some additional integration. I think that you have to put it in the context. The context is the context of Brexit. You know perfectly that the important derivative clearing houses are located in London. Recently, the European Commission has indicated that it will be crucial, it will be key to have CCPs and clearing houses located in Europe, because otherwise, well, we will continue having, you know, a high dependency on the UK CCPs. We have a period of transition because well, we need time in order to produce this reallocation. But I think that the European Commission is sending very clear signals in terms of the need of start to concentrate business in derivative markets, in clearing houses that are located in Europe, because this is a crucial part. This is going to be a key part of the capital market union that all of us will want to develop in the future.
Thank you, Vice President. We have now an additional question from Joe Boderson. Do we have enough private institution money in the venture capital and early equity markets?
Well, it's quite clear that in comparison with the US, we are lagging behind in that respect. No? And here the question is, why we are lagging behind in terms of both public and private equity in comparison, for instance, with the US. And you can have, perhaps, there are two factors behind. The first one is the lack of integration. In the US, they have much deeper and much more liquid equity markets. And that's something that, we do not have here in Europe, because we have fragmentation in terms of equity markets in Europe with different regulations and legislations. And I think that this is an important impediment in order to have a real equity business as rich and as big as in the case of the US. And secondly, perhaps what we have to look at, because this could be an alternative explanation, is that equity markets are especially developed in areas, in jurisdictions where the return on equity is higher. So here, this is an important issue. Why, in the case of the US, they have bigger and deeper equity markets? And perhaps one of the reasons is because they have more investment opportunities and better investment opportunities. And this has to do with potential growth, with regulation, and this kind of things. So I think that our approach should be two-handed. First, we need more integrated, deeper equity markets without national limitations in Europe. But simultaneously, I think that the investment possibilities in the case of other jurisdictions, perhaps, are better prepared and are, much more obvious than those that we have here in Europe. And this is a question that we have to look at. That's why I think that in terms of digitalization and in terms of the green finance and the green transition, I think that in Europe we have a clear competitive advantage in comparison with other parts. That's why I think that capital market union, in relationship with green finance and green transition and with digitalization, are areas where we can try to bridge the gap that now exists, for instance, in comparison with the US.
Thank you, Vice President. We don't have any more questions now. I guess, there's one additional coming in. Just an info, please send written questions to all panelists and not just an individual host. I'm getting now the next question. And the next question reads, you just argued that a strengthened equity market will be better to finance climate projects, but the EU Green Bond Standard and the taxonomy are not compulsory. So more greenwashing possibility than conditions at screening by banks.
Well, I suppose that it refers to the discussion with with respect to the taxonomy and the green investments, no? And I think that this is something now the European Commission is working on that. What I can tell you is that in the case of the ECB, we are in favor of the transparency, of disclosure, and we believe that in that respect, equity investment is much more prepared to fund green projects than debt, because sometimes these green projects demand time and a time horizon that is long, and in that respect, I think that equity is much better suited to deal with this kind of situations. But simultaneously, I think that the question of the taxonomy and the question of the disclosures is something that we are pushing from our side, because we believe that this is going to be a very relevant element in the future.
Thank you very much. We don't have any more questions, so thanks to the icebreakers who submitted questions. Thanks to you, Vice President de Guindos, for bearing with us and for staying cool while the ice was breaking. I wish you a good day. We would then now move to the next session. And this is the session where the European Central Bank and the European Commission will present their assessments on the state of financial integration and structure in Europe. And the first presenter is Philipp Hartmann, Deputy Director General Research at the European Central Bank. Philipp, the floor is yours.
Thank you very much, Philippe. As my slides are coming up, it is a great pleasure to present the ECB's report on financial integration and structure that we publish now every 2 years. And to do this together with my partner, Peter Grassmann from the European Commission, who I believe replaces Klaus Wiedner, who was indicated in the program in presenting the Commission's report. This biennial report has a structural nature, as financial integration is inherently, and financial structure in terms of financing is a structural issue, so we publish it at an infrequent frequency. Let me show you quickly the contents of the report. The report is composed mainly of a core chapter that we call the surveillance chapter, where we review developments on integration and financial structure over the reporting period, and a set of boxes that you see in gray underneath here that touch some specific analytical issues or policy issues. For example, this time it ranges from the role of equity markets in green and digital innovation, something that was already asked in the previous question, on debt issuance procedures and further integration needed, the green bond market, and risk sharing issues. As the data period is 2 years of this report, it basically covers this time the pandemic period since the spring of last year. Over the next 20 minutes or so, I will present selected results from our report, but will not be able to cover everything that you've just seen in the contents. But let me nevertheless start with the more long-term perspective that you see in this chart on the screen now. This chart shows the two composite indicators of financial integration, an aggregate indicator of overall integration developments in blue and in yellow for prices and quantities, respectively. So the blue line across markets shows differences across euro area countries in various asset prices, and the yellow line cross-border asset holdings in various markets. And you see how on the left-hand side of the chart, the integration of progressed in the run-up and after the introduction of the euro in both dimensions. But then the great financial crisis and the sovereign debt crisis in Europe very much deteriorated financial integration. In the middle of the chart, you see that. And after this deep trough, a recovery set in that was initially, after the OMT announcement and the banking union announcements, rather rapid, but then slowed down and became somewhat volatile, as you see in the blue line, for example. And coming now to the reporting period of this report, if you go to the red vertical line that says begin COVID-19 pandemic, you see a little kink, which is actually the disintegration and reintegration coming from the COVID pandemic stresses. So what you see is that what the Vice President previously said, compared to previous crises, this reduction of integration was rather short-lived and corrected rather swiftly. As he pointed out, this was thanks to fast and massive intervention at multiple policy levers, ranging from monetary, fiscal, and prudential. The reduction, the refragmentation through the COVID pandemic was also stronger in prices than in quantities, as you see from the rather moderate reduction in the yellow line, right of the red, the last red vertical line on the right-hand side. Clearly, Europe has benefited from lessons of previous crises here that allowed it, this rather short-lived fragmentation episode. Obviously on the side of the crisis management, as was mentioned before, and in terms of the regulatory reforms that have very much strengthened various financial sectors, not only in Europe, but also globally. Before I come to a more in-depth view of this pandemic episode and what happened to financial integration, let me make a little excursion related to the green bond market, which is actually something discussed in the box 4 of the report. President Lagarde, in a fundamental speech in May 2021, laid the foundations for the idea of a green capital market union. This is very important because the green bond market is actually particularly European and integrated, so-called still small but fastly growing, but in other dimensions exemplary markets for where we are going with capital markets union, or want to go, for example. The box makes an analytical point that is important to clarify when we look at this market going forward, because at the current stage in different countries of the euro area, the green bond market is at different levels of development. That has the effect that domestic investors actually need to hold a lot of green bonds from abroad. The investors from the countries with a little developed domestic markets have to hold green bonds from more developed, from countries with more developed, with more supply of green bonds. This has the effect that presently the so-called home buyers, the overproportionate holding of bonds by domestic investors, of domestic bonds, is very limited in this market. And as a matter of fact, as the market develops also in the other countries where it's not yet so much developed, actually those local investors will also hold more local bonds. So somewhat paradoxically, that would lead in quantities, probably in a gradual way, to some measured reduction in quantity-based integration in this market. This is something to be kept in mind, and it has no bigger implications for the big picture of the exemplary nature of the green bond market. Let me now close this parenthesis and come to a more in-depth view on the pandemic crisis. We are moving now from a particular structural long-term view to something quite high frequency, because in crisis something changes. We have established an infrastructure to monitor financial integration and financial fragmentation at relatively high frequency in crisis. And one of the outputs of this you see in this rather busy chart, I have to confess. It shows you since February 2020 until recent times, the price-based indicator, the same blue indicator as you saw in the previous chart, but high frequency, calculated on a daily basis. Then it shows you a number of dashed lines, which are measures of the severity of the pandemic, deaths related to COVID, stringency of lockdowns, and vaccination rates, for example. And in the red dots, you see a measure industrial production growth for the performance of the economy, for the growth of the economy. And then you see a number of vertical lines that are important events that have happened. So let me analyze the trough, or the W or U, that you see on the left-hand side of this chart from the price-based composite indicator. As you see, the initial fall of integration was rather sharp. And therefore, the decisive policy interventions were also critical for not only for stabilizing the economy in terms of price stability and growth, but also in terms of financial fragmentation. And here I want to point you to what is marked as events 7 and 9, which is the announcements of the ECB's pandemic emergency purchase program. So you see that the let me call it the free fall of a measured integration, price-based, actually gets to a halt after this ECB decision. It's somewhat volatile afterwards, goes up and down, and doesn't reverse yet, but it has stopped. And then I want to point you to the events 24 and 25, which are the announcements that the German-French proposal for a European Recovery Fund and the Commission's Next Generation EU proposal for a sizable recovery fund. And as you see to the right of these black lines, 24 and 25, the recovery is set in motion. So the initial monetary policy intervention, then combined with this fiscal developments and other fiscal developments, actually then made achieve the turnaround. And when in events 28 and 29, you see when the European Council agreed the NGEU, actually this reintegration trend continued, and actually the blue line moved above the pandemic levels. It went to pre-pandemic levels and even went on a further gradual reintegration trend afterwards. So one lesson, there are many lessons in here, but one lesson is that aligned fiscal and monetary policies can be very powerful in a crisis. Here illustrated from the perspective of financial integration and fragmentation. The second thing that's interesting is if you look at the dashed lines of the waves of the pandemic, you see that the new gradual reintegration trend above pre-pandemic levels is actually resilient to the future waves of the several waves that the pandemic had. So obviously this had a lot to do with the remaining policy support, but there was a success in creating a resilient integration context, even though this has to be monitored going forward. Risk sharing is, of course, as the Vice President just explained, impaired in such a situation. And I don't need to dwell on the fiscal measures that were just characterized that would have compensated for the lack of the private sources. There is also another box 5 in the report, that looks at a particular channel of cross-country risk sharing in Europe, the so-called capital channel, and looks whether it functions equally across European regions. In distinguishing a northern and a southern region. And it turns out that actually, even though this capital channel is still relatively weak, and that's one of the key reasons why we need to have the capital markets union and go forward with it, it is stronger within regions than across regions. And particularly, it seems that in particular the southern region of Europe doesn't seem to benefit as much of risk sharing, consumption risk sharing from this channel as we would probably like to have it. And let me close this parenthesis as well. A last remark, and this will be the only thing I'm going to say today about the Ukrainian crisis, and this is not in the report. If you go to the far right of the chart, you see a bit an area which is orange or yellowish, and this is the period since the Russian invasion to Ukraine. And you see what Vice President de Guindos has characterized. You see how the blue line sharply reduces, but it stops relatively quickly, and even much earlier than in the case of the pandemic. And remember, the pandemic was also early by historical standards for European crisis. And if you wish, in these gloomy times, the good news from the angle of financial integration is it even gradually recovers and has now caught up more than half of the initial slump in integration. And let me close this little excursion of the Ukraine crisis and its implication for the European integration as well. Let me move from financial integration to financial structure. And I'm going to start with non-financial cooperation financing instruments. Overall, the financing of firms and households held up during the crisis. equally thanks to the major policy interventions that I just mentioned. I zoom in this chart in here on the non-financial corporation sector because arguably the NFCs were an economic epicenter of the health crisis related to COVID. We can discuss this in the Q&A if you wish, what that means. But from the angle of financial structure, and if you look at the third and fourth pillar in this chart, you see that an orange block and a yellow block moves up, and in particular, a green and a gray block moves down from the year before the pandemic to the first year during the pandemic. This means that not only the financing held up, but also the non-financial corporate sector changed the mix, its financing mix, to withstand the pressure. In particular, it could draw relatively flexibly on credit lines from banks. And second, it could issue enhanced, and that's the bank loans is the yellow block, and it also could use, in particular the large firms, more extensive corporate bond issuance. And the more risky financing instruments, risky from the side of the investors, equity and trade credit actually went down. Obviously, there was a period of dash for cash, so the trade credit couldn't among the firms couldn't function as well, and the equity issuance also went down. But it was more than offset by the increase of bank loans and debt securities. And if to quote here Yung Shin, the chief economist from the Bank for International Settlements, thanks to the post-crisis regulatory reforms, the banks in Europe and also elsewhere were actually able to play their role as elastic nodes in the financial system and thereby stabilize the NFCs. Among the multiple supports that companies received is, of course, salient the fiscal support that they received in the countries and the guarantees, but also through some European programs. Then there was the banks through the post-crisis reforms that were strengthened. And then you saw the boom in the corporate bond issuance. And here also the corporate sector purchase program, which was enhanced through the PEP of the ECB, played a role. And obviously also for the banks, another support were the much stepped up long-term refinancing operations of the ECB. Obviously, all this came at the cost of more government debt and also more corporate debt. And this raises the issue of a future resolution. I will come to that when we talk about CMU. And of course, of a rebalancing going forward after the pandemic in terms of the debt equity mix in the euro area economy. Let me look at the second dimension in our report that our report addresses for financial structure. And this is going from the liability side of the companies to the asset side of financial intermediaries. So what I have displayed here in this chart is the tremendous trend, upward trend, that exists at least since the great financial crisis in investment funds. That's the green line in the chart, which is on the right scale in the chart. You see that there's a persistent trend of more and more equity funds being bought by European investment funds being bought. And if anything, apart from these some stresses in various fund segments initially in the pandemic, is if anything in the last 1 or 2 years they may have even accelerated. And in particular, that equity funds seem to have been over our reporting period the fastest expanding fund category. And you see that if you compare the blue line in the chart and the yellow line, the other colors, they represent the shares of different funds, equity bond mixed funds, and we excluded some other funds in the investment fund sector. And you see that the blue, the equity, very much gained in market share relative to the bonds. And in many respects, that's also good news when we talk about equity later. Much of this equity investment of these funds that were bought, these European funds that were bought, however, invested also abroad, actually a very large share that you don't see in this chart. You see it in the chart in the report. Many equity investment went into in the US and other constituencies outside of the euro area, but not all. Now, that has a good side for the diversification of European investors, But one may want also to keep in mind that it means it didn't particularly benefit the financing of European firms with equity. Let me go from another very specific component of the financial structure and development of the euro area that the Vice President already mentioned, and that is in another box in our report, box 1. The NGO recovery program has a large share in green and digital investments for good reasons, for the great technology transformations that we have in front of ourselves. And thereby it benefits a lot of firms that are engaged in these technologies and industries, notably frontier firms that are innovative. But if you compare even the huge amounts of this program of NGU to what the European Commission has estimated to be the annual need of investment in green and digital technology from now until 2030, which was estimated 650 billion per year, then you see that this alone will not be enough. Substantial additional private investment would be needed. And since we're talking here about innovative firms and innovation, equity finance is the primary instrument, in particular venture capital, for financing the innovation. And if you now turn to the chart on the left-hand side, you see why we promote in this report very much further enhanced risk capital markets for the EU. Here the chart compares 3 categories of risk capital markets: business angel funding, venture capital financing, and growth capital financing in the different colors. And here we only compare to the US, but there are also a few other advanced constituencies for which the picture is a bit similar. The difference in the overall amount of financing, as actually I think was the implicit thought in the question, in one of the questions that were previously asked to the Vice President, is rather large. And now, obviously, in the last 2 or 3 years, as the experts in the field know, there was actually quite significant growth in the venture capital arena, and many unicorns were created in the euro area over this period. But if you look at these numbers, you see that there's still a long way to go in Europe for a vibrant equity ecosystem. And in addition to this, we have still this issue that I mentioned before, that there is an enhanced corporate debt in the euro area, and there needs to be somewhat a rebalancing, also pointing to this to a need to increase these private equity components. Now, a particular bottleneck in this that you don't see very well from the chart, but most experts know, is in the European market for venture capital is the scale-up segment. When successful European firms have to scale up to be internationally competitive, they find it hard to find that scale-up money. And European funds that deal with scale-up tend to be rather small by international comparison. So what are the avenues for developing and integrating further European equity markets? So in this slide, I have listed what is in the pipeline from the September 2020 CMU2 action plan. There's the European Single Access Point for harmonized company information that will include sustainable-related information, and likely contain a proposal to open an SME IPO fund. There's the ongoing review of EU fund insurance regulation that it envisages to facilitate institutional investors for investments in innovative projects. There is, in the November package that the VP mentioned, also the proposal for improving the attractiveness of the European long-term investment funds and making it more accessible for retail investors. There's a planned review of the EU public listing rules, very importantly for SMEs. And there is where hopefully the proposal for the SME IPO fund will come. And we have to do more, go step by step the thorny path of improving the harmonization and efficiency of our insolvency frameworks also from the perspective of the aftermath of the COVID crisis debt creation. Yet, this will not be, it will be tangible progress. If all this is implemented, it will be tangible process, but yet we have to go further. So obviously, as you realize from the previous, from the 2 slides ago, enhanced efficiency and harmonization of equity and venture capital frameworks is critical, including a role can be played here, but also in other dimensions, to reduce the tax advantage of debt over equity. Other directions could include the following. First, provide additional incentives for large firms to for corporate venture capital to invest in small startups and innovative firms. Third, targeted public support to stimulate private equity investments in promising innovative projects. And here, the French presidency, in parallel with the preparation of our report, has launched the Scale Up Europe initiative, creating large pan-European equity funds for late-stage financing. And remember that I characterized this in the previous slide as one of the key bottlenecks in the venture capital, in the European environment for venture capital. And last, recently, the European Court of Auditors brought up a report where it found some missing elements in cross-border distribution of investment funds, which with an equity component, but also other components, and missing data about investment funds, in particular for financial stability and assessments and supervision. Box 3 of our report also makes a point about what more needs to be done on the debt side and points to the better integrated and harmonized debt issuances procedures. But I will not have time to go in the depth of that. Let me close with a banking point that our report also recalls that there are, at the present juncture, significant advantages of further banking consolidation in Europe, in the banking union. It could address structurally low profitability through reducing excess capacities or cost inefficiencies. And if they are cross-border, if the share is cross-border, it would foster retail banking integration, which is still at a surprisingly low level. But as you see from the chart on the left-hand side, after the banking union that came in 2012, this is the value of bank consolidation. There is another chart on the numbers of consolidation, of mergers and acquisitions in the banking sector in the report, was rather limited, even though there have recently some moderate signs of redynamization, which is happened particularly in 2020. Now, the question is what would be done, and the report points out that we think, together with our ECB banking supervision, that remaining obstacles to banking consolidation on the regulatory side could be continued to be addressed step by step. We just give 2 examples here. One is the current European Deposit Guarantee Scheme Directive. There are provisions in there that still limit the transfers of funds, the allocation of funds after a merger. So only the last 12 months in terms of contributions to one fund can be considered for transfer to the fund where the new merged bank will be located. And obviously this is an obstacle to it. There's risk shifting between in deposit insurance schemes, and we would follow the EBA recommendation in this regard to make this allocation of funds more flexible. And in the last report, Financial Integration Structure Report 2 years ago, we pointed to the possibility and explained how an effective use of intergroup waivers for capital and liquidity could be used for cross-border banks. This is the end of my presentation. Needless to say that the banking union, its completion, and the capital market union progress remain important and would foster further integration and resilience of our banking union, and would help the post-COVID recovery if the missing elements are introduced. Thank you very much.
Thank you, Philippe, for the presentation of the report. The report will be published shortly on the ECB's website, and you will find all the details in the report. And we now turn to the European Commission, Peter Grassmann. He will present the findings of the European Commission's report. Peter Grassmann is Deputy Director of Financial System and Crisis Management at the European Commission. Good morning, Peter. The floor is yours.
Good morning, ladies and gentlemen. Good morning, hosts from the ECB. I will try to keep myself rather short, but still want to start with a thank to the colleagues in the ECB having this year round organized the conference in our biannual cycle between Commission and ECB. I think already shows you have done a very good job. I'm very happy about that. I would also like to quickly take the floor, as Philipp Hartmann already indicated. I am not Klaus Wiedner, as indicated in the program. The fact that Klaus Wiedner is at a very short notice not available today has something to do with the policy agenda, the urgent policy agenda here in the Commission, on which I will dwell a bit later in the few minutes I will present. Maybe just to say that Philipp Hartmann did, of course, a superb job in drilling down on broad integration trends in the European Union and the Euro area over the past year. So let me focus a bit more on stability issues and some, in particular, also some very timely and urgent policy issues. Next slide, please. Very briefly, of course, the background is clear. We had a good 2021. We came out of the COVID crisis. Recovery was rather robust. Our corporate sector in particular, on which we were very concerned in the start of the pandemic, turned out rather strong, notwithstanding some areas, some pockets of vulnerability. But overall, there was a broad-based recovery on its way, broad across sectors, broad across member states. And financial markets and financial sector at large proved very resilient. Not only, as Philipp Hartmann pointed out, was the financial sector instrumental in providing finance to the starting recovery, in particular via bank lending, as he pointed out, but the sector remained stable. The sector was able to, particularly the banking sector, to shore up again its profitability, which had fallen to very low levels in 2020 due to provisioning requirements. Of course, the new story, and for some, this is very new, not seen in decades really, has been the development of price pressures, mostly due to supply chain bottlenecks as a sort of like a fallout, mostly as a fallout from the COVID crisis, but also emerging and deepening energy market imbalances. Next slide, please. Briefly, I mentioned that already. I mean, just setting the stage for where we stood before Ukraine hit us. We were overall, our financial sector was rather quite stable. Banking sector with very strong capitalization, high liquidity, very low non-performing loan ratio across the board. So we rather were facing the rather sticky challenges, sticky in the sense had already been around now for quite a while, that we had seen high debt levels. They were even rising during COVID, naturally. High debt, high leverage across all the sectors. I could also add here the household sector, which in itself, of course, lends instability to the system, but high debt levels also mean higher interconnectedness between the sectors. And then also, and I will come to that briefly later, rather rising, I mean, not just real estate prices, but some rising prices in many financial assets. And I say that deliberately real estate is developing more and more into just another financial asset. The financialization of real estate, as some like to say it, is continuing. Financial stability then therefore threatened that these tensions could unravel repricing in financial markets, which would of course hit all those holders of financial assets, starting with our institutional investors, but also others. Corporate risks. We have still the chance or the risk of stress in parts of the EU banking sector. On aggregate, it looks good, as I said, but we also learned from the past that banking sector crises never start on the aggregate. They start with a specific bank, and then via contagion effect might affect other banks, which generally looked healthy to start with. And of course, inflation outlook. Next slide, please. Then came February 2022. Most observers and markets were surprised by what happened, in particular on the 24th of February, or a few days earlier, already with the recognition by Russia of the two so-called republics. So what happened then since then? Clearly, that was a development which not generally was not foreseen by markets, but which was generally difficult to understand, difficult to forecast how it would evolve and possibly end. More profanely speaking, difficult to price even. So markets became very uncertain. Volatility set in, not just a slump, a one-off drop in prices, high volatility. We had then, of course, our economic and financial sanctions. I'll say a few words in a minute. The private sector, EU private sector, globally, I would even say, went beyond, often beyond of what our sanctions prescribed them to do or not with Russia. They went beyond. You know the examples. And they also apply to the area of finance. And then increasingly Russian, let's say, measures, countermeasures in the sense countering, not like a retaliation necessarily, but countering the turmoil and the meltdown in their own financial sector. So they took a vast array of prudential and capital movement restrictions. Next slide, please. Clearly, our measures, I don't want to rattle through them now, but we have adopted a wide list, very wide list of measures covering basically a broad area of transactions, flows to Russia, flows from Russia, financial services, other measures pertaining to finance. Clearly, some acquired more prominence than others. Some obviously were biting more strongly than others. But together they have led to a strong to a serious weakening of macro-financial stability and the very functioning of the Russian financial sector. Warning here, I read now often, the ruble exchange rate has recovered most of its value again since February. Is that not a sign that all is sort of good again in Russia? No, our understanding is that the exchange rate is not currently a proper result of market functioning. There are strong restrictions on inflows and outflows from Russia, so I would be careful in taking the exchange rate, for example, as an indicator for the degree of stress on the Russian on the Russian financial sector and the economy more widely. The situation is serious there, and the very sizable recession will aggravate the situation in finance is only now to set in. Next slide, please. So clearly on Russia, we already mentioned that mostly what I said. So asset prices had fallen. They had to close exchanges for a while. Interbank markets were under severe stress, had to be popped up particular by the Russian central bank with record high repo transactions. So the impact had been sharp, of course, in the very beginning, long lines of cash withdrawal, in particular cash denominated in euro or US dollar. That has slowed down a bit, not least due to our export ban on euro cash, which we have introduced since then. Next slide, please. On the European Union, I did mention market reactions already, which set in as of late February, drop in values, high volatility. I explained that, let me put it that way, this is, in our view, not due to strong exposure of the European Union to Russia, neither in the area of finance, which I will dwell on a bit more, nor the wider economy. Of course, we have some very specific segments where we are more strongly exposed to Russia, be it in the energy or be it in the area of other important commodities. So overall in finance, limited exposure had been always very limited, and since 2014, remember the Crimea annexation and the first round of sanctions by the European Union led to a further kind of drive for autonomy, for self-isolation of the Russian financial sector. So which even further restrained interaction with the European Union in the area of finance. Very limited. We have three large EU banks with large subsidiaries in Russia. There is a bit more exposure. I mentioned again, these EU parent banks are large, so there is no concern that the exposure in Russia might be of any systemic concern to the parents, but it costs money and will cost more money to these. We have some, of course, very important EU CSDs, particular international CSDs, which are have been very active in holding accounts for Russians and dealing with Russian or ruble-denominated securities. And then we had the few subsidiaries of Russian banks in the EU. They are already mostly gone. Market adjustment had been fast and brutal due to concerns about the parent. These are basically on the way of exiting the market. As I said before, the impact on the EU is not the result of direct exposure. It's more the overall uncertainty. It's more the indirect channels, including, of course, very importantly, energy prices. Just on the right-hand chart, you see the Dutch TTF gas futures prices. Should be updated, actually. We should now have the latest one. It's the May contract. So here you see high volatility and partly brutal price pressure Next slide, please. So if direct impact is moderate, we should, of course, still reckon with possibly sizable medium-term impact. And I talk here very, of course, hesitantly because the very event, the belligerent attack by Russia on Ukraine is still ongoing. We don't know where it's evolving into, how vast and how long it will happen. But clearly, we see some medium-term risks. And of course, it's first of all the economic impact. We will see a knock-on effect on economic growth in the European Union. The benign picture I painted before on the trend seen in 2021 of a very healthy recovery out of COVID has gotten a hit. How big that hit will be, we are right now working on our spring forecast amidst, of course, extreme uncertainty, but it will show significantly in the figures as it does already in forecasts you have seen from many other observers and analysts. Cyber risks emanating from Russia. Very clearly, this has so far been one of the few positive surprises, if you want, that cyber attacks have been less prominent and less devastating as feared by some, but still we have to be aware, and we are particularly working also with our financial market infrastructure companies to double and triple ring fence them from possibly further going down. I have to, I think, rush a bit further. Please, next slide. Let me jump to now the first of our two thematic chapters in our EFSIR report, and that is on real estate and macro-prudential tools. As already mentioned up front, we have seen, particularly in residential real estate, a strong pickup in prices, pretty much across the board, and pretty much even across beyond the borders of the European Union. We are joining here, we're sharing here a joint trend across the board with reasons I don't want to dwell into, but I think some of them are pretty well established. So clearly on residential real estate, strong increase. Lending has also been rising strongly. And if you look a bit more long-term, drill down on the bank's balance sheet in the EU since the great financial crisis, you see quite a significant shift of the lending portfolios from, let's say, corporate lending towards residential real estate lending. This has become a very important part of average part of banks' balance sheets. We do claim, however, with our strong view, that some systemic vulnerabilities which were hitting us hard in the global financial crisis are not here, or are here to a lesser degree than back then. We have a banking system which is much more stable, much more resilient, thanks to its own adjustment, thanks to regulatory measures after 2008-9. And we have the COVID crisis risks have been mitigated effectively by many policy measures of particular fiscal, but also monetary. Still, house price corrections, of course, are something nobody can really predict when exactly it will happen, to what degree will happen. But we do know that when they happen, like any corrections, they tend to be messy. They sometimes tend to overshoot, and they tend to afflict pain on lenders. Commercial real estate, just one word, clearly with there, perhaps of course, COVID had a different impact on commercial real estate, rather a price correcting one due to lack or lesser demand for services provided with the help of commercial real estate. But long-term structure changes could add to pressure in some segments. Next slide, please. And now we are right now looking into our macro-prudential toolkit. The macro-prudential framework as such systematically was introduced only relatively recently, 2013, to our banking regulation in order to try to limit the buildup of system-wide risks in banking. Of course, you always had the micro-prudential approach to make sure that risks were properly mitigated and avoided by specific institutions, banking, insurance, and others. But here to try to sort of like also stem a system-wide buildup, which might not necessarily only be addressed by micro-prudential tools. So we are looking right now into the framework since 2013. How has it worked? Still, you might say 8 years. There's a comfortable long period, but still, of course, lessons are very tentative, short. Maybe it is too early to come to very final conclusions, but still we see already some trends and try to draw the proper conclusions. Going back to residential real estate, macro-prudential tools have been particularly often geared to residential real estate. You see, for example, in that slide, the numbers of macro-prudential tools, which were, you saw it in the previous slide, how often they were taken, and a clear increase of trends. Often borrower-based measures like limiting somehow the overall lendable amount, like capping loan to value or a debt service to income, to limit the amount or the volume of bank lending to individual borrowers. Next slide now, please. So clearly, we have to remain vigilant overall in this area, at this crossroads, in particular in the area of residential real estate. So therefore, our macro-prudential review, the review of our framework in legislation, in our view, is important, comes very timely. And so therefore, we will go ahead. Now, just please go down. Last word, please, next slide. Short word on decentralized finance, just to introduce it. I think my time is up. We have our second thematic chapter on decentralized finance. Clearly what it is, we know that this is a decentralized digital environment which can basically assume more or less most roles the traditional financial sector carries out: storage of wealth, lending, trading, and so on. It is, of course, operating differently. And we are looking in that chapter a bit more carefully at the opportunities of that, at the risks. And of course, they are on both sides, they're very elevated. Opportunities are high, risks are elevated, if not addressed. And we then conclude also with policy considerations, which have to be done carefully because our traditional approach of regulating finance, going via the financial intermediary, is more challenging in this case, because here the classical intermediary in that area often does not exist. So we have to address and sort of like set the stage from a regulatory point of view at a different level. And I just would like to conclude with, of course, the reference to our MiCA proposal, Market and Crypto Assets Regulation, which we proposed in 2020 and which is currently under review by our co-legislators, that means by the European Parliament and by the Council of the European Union. Thank you very much.
Thank you, Peter Grossman, for presenting these findings. We have already a couple of questions that I will now read out, just to remind you that when submitting your written questions, please send them to all panelists so that we can see them. Obviously, you also have the possibility to write in the chat in case you are willing to take the stage to ask a question in person. Now, the first question comes from Mr. Richter from the Bundesbank. He asks a question which I think is addressed to Philipp Hartmann on the composite indicator of financial integration. How much divergent are the results over different asset classes, for example, equity, bond, mortgages, and derivatives?
Thank you very much for the question. I would ask us chart 18 to be pulled up on the screen, which is a decomposition of our composite financial integration indicator. They can be very divergent depending on the episode. No, that's chart 18, please. As you see from this historical decomposition, 18, the chart number 18. For example, if you want to look, now we have it, if you want to look at the COVID pandemic, which is marked, the start of which is marked in the vertical line, you see across the four components of the price-based indicator, which is the money, bond, equity, and banking markets, it was particularly driven by the bond markets. Corporate and government bond markets showed a lot of divergence for quite obvious reasons. If you think of NFCs as the epicenter, economic epicenter, and governments providing enormous support, that can also differ across countries at the start before the European programs. But there were also effects of the pandemic in the money market, you see, but not so unusual historically, and somewhat in the equity market divergence. There are other institutions that publish other indicators, aggregate indicators, for example, the Association for Financial Markets in Europe, in its Capital Market Union Key Performance Indicators publication, has a few more market segments than we have, and you could look at them. There's a couple of other things like private equity or debt issuance or other where you also see differences across different market segments.
Thank you. We have then somehow a question which to both speakers, and which said, how much of the indicators financial integration, how much are they affected by the role of large financial centers in Paris, Frankfurt, Dublin, Amsterdam, or Luxembourg? Is there scope for further consolidation of trading platforms? Maybe Philippe here would start, and then I would hand over to Peter in Brussels.
Okay, so let me first say that in the statistical annex of our report, that has been published alongside. By the way, the report, I understand, has been uploaded on the ECB website, so you can also now go directly to the report if you wish. So I assume the same for the Commission. There you have in chart 2 of the annex actually a comparison of the sizes of different financial sectors and in the euro area. And you clearly see this phenomenon of financial centers. For example, there are two centers that are particularly specialized in investment funds. But for the other categories of intermediaries and markets within the euro area, the differences are not that huge as for the investment fund or the broader other financial intermediary sectors. Now we use in our price and quantity-based indicators the usual statistical conventions about location and residence and for the cross-border assessments. So we have the impression that they are reliable and little affected by this phenomenon that in some markets, some financial centers are bigger than others. But obviously, if there's differences in liquidity in some markets, centers compared to others temporarily, then there could be small price effects of this. But in particular in the securities markets, which are already now highly integrated as a rule, you would not expect to in any form distort this, our indicators. Sometimes we do see anomalies, for example, in heavy periods of crisis where central bank intervention in money markets is very big. You can sometimes see movements, for example, in the quantity-based financial integration indicator, in that the cross-border holdings of banks go up and down also as a consequence of our operations. And then we have to be careful how we interpret this indicator. I think that is my answer to this question.
Thank you, Philippe. Peter?
Maybe briefly to add, I mean, this is a fascinating question about the interrelation of financial integration and the existence and operation of financial centers. There is a link, but the link is not so clear and compelling. Think in terms of New York City, Manhattan, which is the financial center for the entire Western Hemisphere. Does not mean, though, that all countries and all markets of the Western Hemisphere are perfectly integrated, or the financial sector, with that of the United States or with each other. So it can foster financial centers, financial integration, but far from it. And we also in the European Union have seen sometimes paradoxical interaction. So can there be still then be in further integration of financial centers? Well, until a few years ago, everybody would have said yes, yes, because there are strong scale effects. And because the European Commission is relentless and successful in tearing down regulatory obstacles for this integration to happen. But we will also discuss, for example, also in this afternoon panel, new technologies in finance, which slightly, perhaps at least slightly or more, alter that picture, where it becomes perhaps less clear how and whether and how the scale effects will turn out. So I would be a bit more hesitant these days to expect simply or to bank on sheer market forces to foster further integration of financial centers within the European Union.
Thank you, Peter. We have now an additional question, I think, which applies to you, that is on the macro-prudential measures. If colleagues can put up that question again exactly. Is there scope for EU-wide coordination of borrower-based macro-pru measures? How can this coordination be best achieved? Does the lack of coordination of macro-pru measures contribute to financial fragmentation?
You clause in CRR asks the Commission to examine whether that should be also added to the EU macro-prudential toolkit. recall, currently this important set of measures is based on and applied by under the purview of national law in member states where they exist. The member states adopt and adapt the instruments as they wish so. We are in the plain process of looking at that. We just received answers on our call for technical advice, and we put out also a consultation. Looking at the replies, many respondents to that consultation were rather supportive or positive of including such measures in the EU macro-prudential toolkit to try to make it more complete, that toolkit, and not leave out important parts. However, they also note that the design of use of calibration of these tools must remain flexible. Flexible is also to allow member states authorities to apply them in a way most conducive to the specificities of their market. I want to stop here because I said we are in the process of reviewing that, and we haven't clearly come up with a institutional commission view on that.
Thank you. We have the next question from Paul Mignon to Philipp Hartmann. You didn't mention the GSIB score as one of the obstacles to the bank consolidation, while this score considers every EU transactions as cross-border, penalizing pan-European banks. Do you consider that the alternative EU methodology implemented within CRD5 has succeeded to solve this issue? Philippe?
Thank you. I mean, Peter should also feel free to come in on these questions only and compliment me, but I can maybe make a start is that, yeah, we have discussed this, and I would like to point to the fact that the GSIB score methodology is a G20, is at the Basel Committee level, is a Basel Committee regulation that has to be implemented in Europe. So there's an international dimension to it. And obviously, from a European perspective, there is this small tension between having a banking union, which is, and on the other hand, having different countries. And so we need to align what we do with what the Basel Committee discusses. Obviously, we want to go our banking union forward, and therefore measures that make it easier for banks to cut across borders are desirable. But we also need to see what the Basel Committee will in the end come up with under this dossier. Maybe, I don't know if Peter, if you want to complement.
Okay.
I'll pass that.
Okay, good. Then we have an additional question from Miriam van der Sticheles, Center for Research on Multinational Corporations. And she asked, given the high volatility in energy derivatives markets that result in volatile and high energy prices, have the commodity derivatives markets been sufficiently reformed through EU laws, for example, through MiFID II, etc., so as to avoid excessive speculation? Should more be done to change market-based pricing of fossil fuel energy in light of the current impact of the high prices on citizens and for managing the impact of the climate risks? Maybe Peter, would you give it a start, and then Philippe here could complement?
Let me give you a tentative answer to that very important question. Indeed, of course, we see these days very high volatility in many commodities, not just energy, but let's say in particular in some energies, gas in particular, high volatility, which leads to strain across the board, starting from the consumer who has a higher bill, all the way down to the functioning of derivatives markets and hedging, where, for example, margin calls in CCPs have skyrocketed and really straining the financing capacity of our energy companies. Could regulation do something to reduce these price hikes and the volatility? I would be careful on that. I mean, we are open and we are constantly studying that. But of course, you know that the very cause of these increases lie elsewhere, sort of like in the real world and partly east of the European Union, where, and I've pointed out to that also before in my presentation, that compounded with high uncertainty. You know, for example, right now, our European leaders are discussing the very possibility of stopping the import of, for example, fossil fuels of the European Union from Russia altogether. Yesterday, the Commission proposed to start with coal. But there is, of course, high uncertainty where that very extraordinary journey will lead us. So is it the markets? Is it excessive speculation? I would be careful here. We looked very recently, we, the Commission, but particularly our ESMA, looked at the functioning of emission trading schemes, for example, which were considered by some as a culprit, a conduit of high rising prices. We looked at the market structure. And of course, there we saw the presence of many operators which were a bit more remote from the immediate business. These were not emitters only. And indeed, some also took speculative positions. But overall, the result was rather that this overall increases liquidity to the market and rather reduces volatility than the other way around. So in short, we have no smoking gun that it would be excessive speculation which would lead to this extraordinary outcomes in energy markets these days, but rather very plain fundamental factors.
Thank you, Peter. Philip, would you like to complement?
No, I'm very happy with Peter's answer.
Thank you. Then we have a last question, I would say, before we break, and that comes from Elena Stefanatou from the European Business Angels Network, asking our assessment, or the Commission and the ECB's assessment of the future of business angels and venture capital in Europe, and how to encourage them to invest more. Maybe I would hand over to Peter, and then Philip could conclude. Peter?
Yes, this of course leads us to our wider agenda on Capital Markets Union. Business angels can play a very conducive role to further fostering investment and the development of sort of like a small and mid-sized corporate infrastructure in Europe, which we have, but which has to be made now future-proof more so. And there, these business angels can come in very handy. We have also seen that they can also drive our, what we call our twin transition, the digital and the green transition. So we are thinking on how they can play a more important, a more prominent, a more successful role in fostering transition of the corporate sector of Europe.
Thank you. Philip?
Yes, I have a quite similar answer and not so much to add to Peter because, first of all, obviously, ECB is not competent for venture capital markets as such. We mind about it from a broader perspective of the transmission of monetary policy in well-functioning capital markets and good growth prospects for the economy overall. And if maybe my slide 7 would be pulled up again from my presentation in the meantime. We didn't in the report single out business angels particularly, except in the data that you will see in a second that I already showed once. So we think that in the packages, either that the ones ongoing under the CMU2 that I listed, and the further actions, the overall ecosystem, equity ecosystem and risk capital markets would benefit. So here you see on the chart again, the business angels in our data are the blue parts in these columns. And what I think motivated the question to some extent is that that you see that the blue is a material part of the US venture capital ecosystem, and in the euro area it's so small you can't even see it in the chart. So we would believe that from the overall packages, business angels would benefit. For example, if we can make further progress on the debt equity bias and taxation, for example, which I mentioned. But I also hope that co-financing models related to the progress expected potentially from alternative investment fund arrangements could also play a constructive role. And yes, so I think that's what I have to say.
Good. Thank you, Philip. Thank you, Peter, for being available to present interesting analysis by the ECB and the European Commission colleagues, and for answering questions. We will now have a 15 minutes break, and please come back to the panel 1 session on private capital markets. See you soon. board member Isabel Schnabel. It will be on private markets. Before handing the floor over to her, let me just recall, please enter your questions as of now, doing so in writing via the chat function. Please send them to all panelists, address them to all panelists. You can also raise your virtual hand, and the last way of doing it, you can also mention in the chat function that you are willing to take the floor and ask the question in person. But I hand over now to Isabel. Good morning.
So thank you very much, Philip. Good morning to everybody. It's public investment and private capital markets with a special focus on Europe. Innovation refers to the development of ideas and technologies, and through its effect on productivity, it is the most important driver of economic growth. It is essential for tackling the two most pressing challenges of our times, or two of the most pressing challenges of our time, the digital and the green transformations. And in fact, these two transitions are closely linked. To give you one simple example, the push in the digitalization of our working life that we have experienced since the start of the pandemic allows us joining virtual video conferences such as this conference rather than traveling to meetings, which reduces our carbon footprint. At the same time, however, we should of course not forget that digital technologies are also energy intensive. Empirical evidence shows that more innovative countries are displaying faster progress in both the green and the digital transitions. According to the European Commission, the additional amount of private and public investment required to green and to digitalize the EU economy amounts to 650 billion euros per year until 2030. This corresponds to more than 5% of euro area GDP every year. The largest part of this required investment must come from the private side. However, to kickstart private investment, public investment is essential, for example, in fundamental research or in infrastructure. The Next Generation EU program, with its strong focus on both the green and the digital transitions, offers a historical opportunity to make a leap forward. And given the strong complementarity between public and private investment, the funds from the recovery program, if used wisely, can pave the way for private investment activities that are at the core of the large innovation effort required to master the green and digital transitions. Private investment requires funding throughout the research and development process, including the dissemination of the new technologies. And while public funding can play an important role in the initial stage, private capital gains importance over the life cycle of the new companies. The European financial system continues to be bank-based, but equity financing may be more suited to fund innovation. And in fact, the literature shows that the share of equity-based financing in an economy is positively correlated with innovation. And this is also true for innovation related to the green transition. Private equity and venture capital markets are central to financing high-risk projects with potentially high returns. While risk capital markets in the euro area have grown in recent years, they are still lagging behind in international comparison. In particular, there appears to be a financing gap for the scaling up of new companies. Besides venture capital, scaling up requires well-functioning public equity markets, as initial public offerings are a key exit strategy for firms backed by venture capital. Deepening private capital markets to foster, in particular, equity-based financing will hence be essential for innovation. And this is one of the key aspects of the European Capital Markets Union, which has been advanced further through the European Commission's Action Plan of 2020. A green capital markets union specializing on the financing of projects related to the green transition may be particularly promising to foster innovation in an area that has gained further importance due to the horrible war in Ukraine and the resulting impetus to foster the European Union's strategic autonomy, including in the supply of energy. I will now hand over to our 5 distinguished panelists who kindly agreed to share their views on these important topics. And each of them will start with a short introductory statement of no more than 5 minutes, trying to answer the following 2 questions. So first, what are the most important policy proposals to further support the development of private capital markets and thereby support innovation in Europe? And second, which frictions are these proposals supposed to solve? And we are going to start with Caroline Gabor, who has been the CEO of Movings, which is a joint venture between Mercedes-Benz and Swiss Re since March 2020. Caroline is an experienced entrepreneur with enormous expertise on finance and insurance startups. She was the managing director of FinLeap, a large fintech ecosystem, and she was instrumental in developing new business models from scratch and supporting the successful growth of innovative companies. So Caroline, the floor is yours.
Thank you so much, Isabel, and it's a great honor to be part of such a great round of panelists. So let me start with a few numbers. I just looked it up again to believe it, but if you think about how much money is needed to bring our economic growth to, say, 3 to 4%, then we're talking alone for Germany for 100 billion euros of annual growth financing. If you compare that, and this is what we always do when we think about the EU and venture capital, private equity growth financing, we always look into the US market. So if we compare the EU with the US market, the US spends 8 times more per capita on growth financing. So this is a long way to go. When we look at these numbers, what do we need to get there? And I want to focus my asks and wishes as an entrepreneur on one thing today, and this is people and the best talent possible. So when I've learned something in my 10 years experience as an entrepreneur, in order to create these super champions that we need, that have the revenues in a couple of years and create millions of additional jobs in the EU to end up in that fantastic economic growth, we need the best talent. And this is something where we're still lacking because we have and see, especially in the scale-up phase, a massive brain drain. Founders who are not able to scale startups beyond certain markets, they get financed by US VCs, they leave the EU market, and they bring the entrepreneurial success that we in the beginning financed with business angels, with venture capitalists, early stage funds, they bring this to the US market. And even more so, right now to the Asian market. We should not forget about these circumstances as well. So what do we need when we say talent? It's there are 2 things we have to do. We have to bring and attract the best talent around the world, but we also have to create it ourselves. So one simple thing is we need super easy and homogeneous visa and immigration processes. There's one website where you go as a tech talent, as an entrepreneurial talent. It's a super easy thing. And it's not that we put hurdles here, but we attract the talent by making it super easy. We also need very consistent and competitive tax regulations, especially when it comes to virtual shares and stock option programs, because this is what attracts the tech talent right now. You can't offer a huge salary, but this is something what we can put these people in their hands. We need to not only attract best talent from the outside world, we also need to create that talent ourselves. We need the best possible, most advanced tech centers in our hubs across Europe. We need universities that are not only run by the best academia, but also by entrepreneurs who combine all our great research and development that we have in the EU with very practical and commercially driven entrepreneurial mindset and know-how. If we have that great talent, if they create these super champions, we need to allow the companies, the private companies that have all that money to invest in them. So it would already move a huge needle if insurance companies and pension funds could not only invest 1%, but maybe 2% in this type of asset class, venture capital, growth capital. We need regulations that allow those super champions to easily scale across markets. Let me make the simple case of our Know Your Customer process. The EU had a great idea on how to make a regulation that was homogeneous, but how this is put in place in every single country of our beloved EU is so different that it's actually really, really hard for a B2C company today to scale across Europe. And there are many, many other regulations we can talk about later, but this is probably a very good example. And let me finish with one other ask. Reading a document yesterday of the EU, looking at the different websites with all our great programs, I would love, and as an entrepreneur, a joint effort of rebranding the EU to become less bureaucratic and commission-driven, but to be a place for innovation, technology, and entrepreneurs. Thank you so much.
So thank you so much, Caroline. That was a very inspiring introduction. Thank you in particular for stressing the talent aspect. So maybe we can discuss that later, whether if you have the right people, then the money will more or less follow automatically to where the great minds are. So let me move on to our second fantastic speaker, who is Anne Vosmaal. And she is the director in charge of equity funds at the European Bank for Reconstruction and Development. She has over 25 years of experience in the private equity sector and holds numerous supervisory board and investment committee memberships with major fund managers within the EBRD's countries of operations, and also represents the EBRD and major industry bodies, most notably as chair of the board of directors of Invest Europe. So Anne, the floor is yours.
Thank you very much, Isabel. And I wanted to thank Philippe and the organizers of the conference today for inviting me. I'm deeply honored to be part of this panel. And I would like to start the notes I had prepared very much follow on what Caroline just told us. And the way I was going to present this is we need to act at all the different stages that we're looking at. So first, when we look at the level of the entrepreneur, an entrepreneur needs the incentives to be able to experiment. It's also a question of culture that goes to our education. And this is maybe the biggest difference between the US and Europe. It is okay to fail. And that plugs into the regulatory aspect. How easy is it for an entrepreneur in the EU to start a company, wind down the company, reorganize the company? And that ease of doing business for the entrepreneurs plugs directly into also the risk appetite for receiving the funding. Then the second remark I wanted to make is that private equity and venture capital are a very efficient tool of allocating the existing capital. That is because they have the capacity to allocate the funding to the right enterprises. They have the capacity to add value to companies. They have come up with the right business plan. And also they're able to manage an entire portfolio for returns, which makes it very important to attract the capital. So that brings me to the last part. How do we attract more capital? but I think all the prior steps are very important. The way I'd like to present this is that Stanford University was there before the Silicon Valley and not the other way around. So we need, I completely agree with Caroline said, we need the talent, we need the regulations to ease that talent, to ease the private equity funds and the venture capital to do their work, and then the money will flow. Of course, on the side of the capital, we completely agree with the fact that the innovation in Europe needs to be financed by a combination of private and public sources. And the public financing needs to act and incentivize for the private financing to come in. So with that, within this, the first point I want to make is that it's important that this public financing behaves as private finance would, but with the capacity to take more risk. The idea is not to flood the market, but to do this in a skillful manner and an efficient manner. From that point of view, what would really help on the EU front to incentivize more private financing is a set of regulatory initiatives at the level of the institutional investor. The risk capital weighing for banks and insurance companies needs to incentivize the allocation of capital to private equity and venture capital. Large private investors should even be incentivized to support the startup and the scale-ups. And some tax incentives could be helpful, and we can come back to that a little bit later. And there's also the need to have the support of the EU law to incentivize cross-border in order to be able to create bigger players. I think I'll stop there for now, and we can go back to the different items later.
Thank you so much, Anne. So the institutional investors now came up for the second time. So that seems to be a major concern. Maybe later we can also discuss whether it matters that in Europe you have a lot of pay-as-you-go systems which simply do not generate as much of a supply of capital as when you have a capital based pension systems. Maybe that is something that we could also discuss in addition to the very important aspects of regulation and incentives that you mentioned. So let me move on to our next speaker, who is Alain Godard. So Alain has been the chief executive of the European Investment Fund since January 2020, and he was appointed to this role following his excellent track record as a Director General and Chief Risk Officer at the European Investment Bank. And there he made many important contributions, for example, to the design and implementation of the investment plan for Europe and the European Fund for Strategic Investments, as well as to the establishment of the European Financial Stability Facility and the European Stability Mechanism. Obviously, very important projects for Europe. So it's a pleasure to have you here, Alain. We are looking forward to your introduction.
Thank you, Isabelle. Good morning, everyone. Thank you for inviting me. I think, Isabelle, you set the objective of that meeting very well from the outset. I think you mentioned that the equity investment is key for innovation, and indeed you refer to a high correlation between the two. I just want to confirm that, and indeed a lot of progress has been made in Europe, in particular in the EU, since years, I would say actually 2 decades, and but remains an important gap indeed when we compare ourselves to the US market. And you refer also to some figures. I would not want to provide an avalanche of other figures, but one is important to compare the European venture capital fundraising, which represent 0.1% of our GDP in Europe, as compared to 0.4% in the US. So it tells you how big is indeed the gap when we compare EU to US. I'd like to echo what you also said, Isabel, in one particular segment, which is very important for Europe at the moment, which is what we call the scale-up segment. So we are talking here about these startup companies, which at one point are growing very fast and require much more financing that they were needing initially. Europe has been supporting very well startups again for the last years. The EIF has contributed a lot to the development of the market, as you know. But there's still a lot to be done in this particular segment, and I would also provide you some element of comparison for that. In the US, we count approximately 40 US investment fund of an average size of 2 billion. In Europe, we have about 3 funds beyond 1 billion. And the consequence of this is very simple. About 3/4, 75% of our fast-growing companies, startups, are actually refinanced at a later stage by US investment funds, and even nowadays by Asian investment funds. So when it comes to innovation, also autonomy, sovereignty, this is an issue which is particularly relevant for EU at the moment, and I would not even mention how important it becomes now in the current, say, geopolitical environment. Therefore, you ask us before, Isabel, what could be the policy proposal to address, this particular gap. Here, I'd like to refer to a work that has been conducted by many countries in Europe over the last 18 months, also with the support of the European Investment Fund, to create what we call a EU fund of fund, which we target to have at about 10 billion, 5 billion coming from the public sector and 5 billion from the private sector, in order precisely to support the creation or the emergence of more than 10 to 15 bigger funds in Europe, in order to be there at this later stage of the financing of these startups that critically need EU financing in Europe. And this is not only, let's say, a question of having more EU fund into the financing round, but it is addressing, as you know, a certain number of consequences, very concrete, and notably one that I can mention. The talent have been mentioned earlier by a panelist, and this is very relevant. But not only, you see that the center of gravity of these companies are necessarily moving at one point from Europe to elsewhere, in particular in the US. So nothing against investment from the US partners, obviously, but it is also very important that in Europe we are able to give hope to our startups to develop, stay, and even internationalize their business from Europe. And this is what has been agreed by the member states, in the 8th of February, to create this 10 billion fund of fund that will be managed by EIF in the next months to come. Thank you. I close my introduction with this. Thank you.
Thank you so much, Alain. We are certainly going to come back to this very important proposal. So what you're saying, and I think the others were also alluding to that, is that we not only have kind of a brain drain, but we actually also have a project drain, with the projects kind of shifting to the US or maybe to Asia. And the question, how can we kind of create the ecosystem that is needed in order to make it attractive to stay in Europe? And I think this is really a fundamental question that we will have to find a good answer to. So thank you so much. So we're now going to move on to our next panelist, who is Marco Darin. He is an associate professor of finance at the Tilburg School of Economics and Management. Marco's research focuses on entrepreneurial finance, venture capital, private equity, and public policy for entrepreneurship. And his articles have been widely published in many renowned academic journals. He's one of the leading experts on entrepreneurship, and therefore he has been the consultant to several international organizations, including the European Commission, the OECD, and the United Nations, and he has also advised various governments. So thank you so much, Marco, for being with us, and we are looking forward to your contribution.
Okay, thank you, Isabel, and thanks for the organizers to put me on this great panel. And it is actually a little bit thrilling for me, because I mean, what I heard from Caroline and Alain, I mean, makes me revise on the spot a few of the notes which I wanted to share, because I think it's kind of, there are some very important themes that I would like to start get rolling to comment on. So I would kind of really try to complement their views from that of let's say, an economist who has kind of a longer term, more detached and more comprehensive, hopefully, view. I would also like to start with a few numbers, actually from the report that we are which has been presented today, which I advise all participants to read, because it is full of very interesting information and analysis. So in chapter 5, there is this figure which shows that compares Europe and the US, as my predecessors have also done, and highlights the fact that whereas in let's say early stage investments, the gap which is there is kind of has been reducing a bit over time, or at least it's less pervasive, both in seed stage and in late stage. So this is kind of really very deep, remains very deep, and so kind of what I wanted to point to is that there is an imbalance on both sides outside of the early stage. Kind of, so we have heard some thoughts about, in a way, both of them. But I think it clearly, from my perspective, it is important that we think of providing, from the point of view of the supply of funds, a well-structured supply chain to entrepreneurs, which starts with seed financing. And I think that Anne was mentioning something about kind of giving tax breaks to angels, if I understood correctly. I think it's kind of, it is very important that let's say the angel type seed financing in Europe gets incentives to become more risk-taking, because that's one of the gaps that I perceive by talking to many entrepreneurs. And so that is one margin which I think it is very important. Clearly, offering tax breaks, I mean, I'm a little bit skeptical about this, because I mean, we can discuss this a little bit later, because it's something which happens mostly exposed. But creating, I think that in that sense, probably I would favor even more an increase in the quality of, let's say, reporting systems and insolvency system, legal system, which makes it easier for investors to keep a close eye to monitor the companies and recoup something in the case of default, which is the standard, as kind of the most common, not the standard, but the most common outcome of an entrepreneurial company. That's something that we have also to keep in mind. On the scale up side, I think that there as well, kind of there is a big gap in terms of creating the competencies, okay, not just the money, which is, as Alain was saying, I mean, we can help provide flows which goes into there, but kind of the type of investment which is done at a late stage, at the scale-up stage, is different and requires different types of skills and experience on part of the investors. And so we have to move in that direction, as well as kind of another point that I wanted to bring up is that the European Investment Fund has been extremely successful, I think, in over the last 2 decades to help the especially the early stage set of European venture firms. At the same time, kind of, I think that this has I mean, there is a risk that it remains a victim of its own success, in the sense that an institution like this one needs to kind of constantly reinvent itself, which is a big challenge. Okay, and I know that kind of I've known a lot of people working at the EF over the years, and kind of there is a huge amount of professionalism there and abilities. There is a mandate also that the fund has to satisfy, and so in that sense, I think that a constant, I mean, here I don't have kind of a clear proposal. I mean, I think this is also something which is kind of quite politically sensitive and important in a good sense. But I mean, the fact that the European Union reinvents and is able to kind of provide a renewal of mandate to the European Investment Fund, I think it is something very important. Then I will close with I prepared some notes about specific measures in the action plan. But I mean, let me get back to what Caroline and Anne were saying before, because I think it's more important, and we can get back to the specifics later on. I think one thing that we have to be aware is this of agglomeration economy. So the fact that when we talk about Europe, and kind of we say, hey, we want to create a very entrepreneurial and innovative economy, that's very good, but these will be seeded in certain places. Okay, so it's true that in the last 10 years we have seen kind of the Silicon Valleyization of innovation in the US. That is kind of the creation of a good number of innovation and entrepreneurial hubs, which are typically specialized on kind of smaller, a smaller number of sectors. But this will also mean that in Europe, we cannot just think that it will be kind of free goods for everybody. I mean, it will be successful hubs will likely be located in 2 or 3 places predominantly. Okay, and so there is an issue which I think we should be aware of, kind of political frictions. Okay, because this will not be again where everybody wins completely. Kind of there will be major winners and countries or regions which will be kind of largely left out, because that's in the nature of this business. It's an unequal. We like a lot to talk about equality and so on, but here is the reality is stretching us. Okay, we have to accept that if there will be kind of a couple of European major hubs, there will be a couple, and they will be located in certain places. It's good that there is certainly competition between countries and regions to achieve this, but we have to be aware that kind of how do we manage this? And I think it's something that I never hear in the public debates, but it's something which is important. Okay, we kind of, if you talk to people with closed doors, that clearly often comes up. So I just kind of wanted to play a little bit the role of bringing this in the discourse. Okay, I'm done. Thank you very much, and I hope that we can keep having a great debate. Thank you.
Thank you so much, Marco. Many very interesting points. So maybe later in the discussion, I would be very interested to hear. I mean, given that you've done so much research on these type of issues, I mean, you mentioned that the EIF was actually quite successful, and maybe you can say a few words about, I mean, what has worked and what hasn't, if you look at it kind of empirically, if you have any insights on that. Then I also see that several points are coming back again and again. So the question, what is the relative role of public finance and private finance? How do the two go together? What are the complementarities with other aspects like capital and competences, as you said? And then you repeated a point made at the very beginning by Caroline, that things have to be much simpler and less bureaucratic, which also seems to be a recurrent theme. So thank you very much for these insights. So before I move to my final panelist, let me remind the audience that you can, of course, already now post questions in the chat. Please make sure that you address the questions to everyone so that we can see them. But now I come to Guntram Wolf, who is the final panelist, and he is still, I could say, the director of Bruegel. And under his leadership, Bruegel has been regularly ranked among the top global think tanks, and it has grown enormously in influence and impact. And I think it's fair to say that that's partly due to Guntram himself. He's a well-known academic. He regularly testifies at the European finance ministers' ECOFIN meeting, the European Parliament, the German Bundestag, the French Assemblée Nationale. And I think it's fair to say that he is one of the key thought leaders on European policy issues. And therefore, Guntram, we're very happy to have you here and hear your thoughts about our topic.
Thank you so much, Isabel, for this kind introduction. And thank you also to Philippe for including me in this prestigious panel. It's really a pleasure to be here. So I really wanted to just make 3 points. I mean, the first is really about where do we stand. The second is about what is the opportunity. And the third is about what are the risks. So these are my quick 3 points. And I think on the first one, where do we stand? I mean, I cannot help but think, okay, I've seen what we've just heard. I've seen it many times before. I mean, just going back, thinking about the Lamfalussy report from 2001, the De La Rosière report from 2009, and then later on, of course, the big push on capital markets union. I mean, this has been an agenda for more than 2 decades. And the agenda is very clear. The agenda is very clear. We need to not only increase the depth of non-bank-based financial intermediation, so capital markets based financial intermediation, but we also need to reduce fragmentation across countries, and so basically unify this and create ideally one liquid market. The progress with this agenda has been, I would say, quite moderate. There have been some successes, but including some institutional successes in the sense that we have built some supervisory tools in that space. But overall, it is fair to say that the European financial system continues to be bank-based, essentially, and the banks really play the predominant role in providing finance. And the one big financial center that we had has, of course, left, which is London. So this is, I mean, we haven't mentioned that yet, but of course, it's also an important aspect that London has been an important financial center also for the European Union, and continues to be in many respects, bringing all kinds of challenges. And since Caroline mentioned the talent aspect, a lot of the high-tech talent actually also sits in London and not on the continent, unfortunately. So I think this is a big agenda, and I think it's very important, all the points that were made on regulation, the cultural aspect. I'm always finding it difficult to classify the cultural aspect, but yes, there may be some cultural aspects here why we like to. And Isabel, I'm looking at you also. We the Germans, we like to save in our bank accounts as in deposits still. I mean, so there might be cultural factors, but there might also be regulatory factors really determining this. And I think really reviewing those and being ready to break some political taboos is going to be so important if we really want to strengthen this capital markets union agenda. Now, my second point is the opportunity, which is really about where I think there's a big opportunity now. It's in the space of green and also digital, but I would say more green innovation. I mean, green technology is, I think, a huge growth market. The European Union is doing quite well, but I mean, we are also at risk of losing the edge if we don't rapidly move in that space. And you know what we are doing now is, and I think this is the interesting part, is we are putting the necessary public funding on the place on the plate. So the public funding with Next Generation EU, the European Recovery Fund. I mean, the public funding is there, and there's this, and that public funding needs to be shaped in a complementary way to private funding, not to crowd out private funding. And a lot of the discussion I hear often is very much more in the spirit of let's have as much public as possible, just to avoid the pain on the private sector. But I think it's the wrong way around. I mean, we really need to incentivize the private investment in the green space, and thereby ensure that you know, new technologies and new technological firms really become leading firms in that space. And I think there's really a great opportunity with this Next Generation Fund to really shape that agenda, and really have this sector as a growing sector, both on the real economy side, but also on the financing side, where green bonds, etc. I mean, these are all financial products also that could be something where the European Union and the European continental market is leading. So I think this is I would identify this as an opportunity, and it's a market of just to give the size. I mean, according to Commission estimates, we need to invest something in the order of up to 400 billion per year in our energy and transport systems to basically achieve the aims of the Green Deal. And a quarter of that is publicly funded, perhaps on average. But so that remains. So we get 300 billion per year funding need in the private capital markets. My very last point, sort of, what are the risks? And you know, I guess I cannot avoid talking about this. I mean, we tend to, when you talk to bank supervisors, they tend to immediately start worrying about basically some of the non-bank based financial intermediation that is growing. And we have seen the growth of some segments of venture capital in the last couple of years, where I guess as a supervisors feel a little bit uncertain about you know, what kind of exposures are there. And so I think the basic message here is, as we grow our private capital markets, and as we integrate them cross borders, we have to also step up the agenda of basically supervising these market segments. And ESMA is, of course, the institution that should take the lead and is taking the lead here. But it's very important that the supervisory integration and stepping up goes hand in hand with the growth of these markets, so that they are not some hidden risks. Highly leveraged finance can be also risky, and so we need to be aware of those risks. Let me stop here. Thank you.
Thank you very much, Guntram. So I like the way you structured the discussion, and you made very interesting points. I think we certainly will come back to this question of crowding out private funding or crowding in private funding, and how this can be done. By the way, I think one very important aspect on that is that, I mean, it's not just about funding, but I mean, when it comes to like angel funding and so on, it's also a lot about project governance, right? And that actually matters. And maybe the angel investors are actually much better in doing that than let's say governments. So this, I think, is an aspect that we also should discuss. On the risks, I would of course be interested in hearing what you see as the major risks there. I mean, given that we are, of course, I mean, we're talking about equity funding, which of course has very different risks from kind of debt funding. And so let's discuss that later. But maybe, so first let me point out that I just learned that Alain is going to have another important commitment. Unfortunately, we just came in, so he will have to leave around 12 o'clock. But we will give you the floor before that in any case, Alain, so you have a sufficient chance to participate in the discussion. So let me start with the point that Guntram made at the very beginning. So how is the situation? How bad is it actually? So I would probably share his view that we've been discussing these things for a long time, and sometimes we have the impression that very little has happened. So what are the panel's views on that? And please, whoever wants to come in, please. So who wants to start? I don't know, Alain, given that you have to leave earlier, maybe you want to say a couple of words on that, where you see the current situation?
Thank you, Isabel. Let me, maybe in the interest of time, and again, I apologize for having to leave earlier, but I would like to come in on the point that you made earlier on the public-private complementarity when it comes to equity investment. And I'd like also to remind another comparison between the EU, Europe, and the US from a timing perspective, and therefore to refer to the investment that was made in the equity the business or the venture capital more than 40 years ago in the US, whereby at the time it was mostly public investment supporting very much, I mean, the creation of an ecosystem at the time. So when we compare and when we hear that there may be a need indeed to leverage more on private sector, which I would fully support, I would also like, I mean, to put things into perspective. And again, I think one of the key elements or key risk that I can see today when we compare to other markets is the question of speed and probably size as well. We have indeed quite a gap as compared to other markets, which means that not only in the scale-up that I mentioned earlier, but in other segments, we see more and more investment from other non-EU or non-European investors. And therefore, it's a question of recovering from this gap that we have with other players on the market. And therefore, speed is of essence, but also size. Why size? Because when you compare, I gave that figures earlier, and thank you also for the ECB report, which was also providing interesting quantitative information on precisely the comparison between the US and Europe, which demonstrate very objectively that we need, I mean, to do much more than what we have been doing so far. So the question of size is important. It's important for what we call the scale-up. But in general terms, we are not quick enough and we are not bold enough when it comes to equity investment in Europe, and hence the importance of innovation behind these investments. So for me, I would not oppose public and private investment. On the opposite, I think that, and this has been the case of our proposal to the member states recently, to use precisely the capacity of a public institution, well known in the market, to leverage, catalyze private sector investment into this particular segment. But this applies, I would say, and by experience, long experience, we see that on the market across, that when a public institution like EF is present in deals, it immediately favor a lot of private investors too. And therefore, we tend to say that when EF, for example, invests €1 of public money, we catalyze up to €5 of private money. So you see that this is not something we should oppose, public and private. We should, on the opposite, we should talk about complementarity indeed, and catalytic effect by putting more money from the public in order to leverage more money from the private sector. So this is, Isabelle, let's say, the contribution I can make to this debate. And thank you very much.
Thank you very much, Alain. I think that was extremely useful to stress again that this is really an important complementarity. And I see that Anne wanted to come in on precisely that point, and maybe also on other issues.
Yes, I really wanted to reinforce Alain's point. And in the countries that we have in common between the EIF and EBRD, of course, we work together. And I think that point is extremely important. It also reinforces what Guntram was saying, is that the public and the private need to be complementary, but the public must not crowd out the private sector, because if we do this, we achieve the exact opposite of what we're trying to do. And it's a really fine balance of having the right amount and the right structure and the right incentivization of that public money so that it doesn't crowd out the private sector. I think this is really extremely important, that public money is necessary, but it really must not crowd out the private sector. And we need to sort of prime the pump, but then slowly withdraw. And I think this is what we do with our participation in funds, is that initially EIF or EBRD will be able to take a bigger commitment in a fund in a market that is very underdeveloped, because we have the capacity to take more risk than a private institution. But then as private institutions become more familiar with the risk of a specific region, for example, and with a specific manager, then we, public capital, are able to reduce our commitment to these funds. So I think that's extremely important point.
So thank you very much, Anne. So can we be a bit more precise? So what does it mean to be complementary? So I mentioned the governance issue, which I actually find quite important. And the question is whether there's not also a clash of cultures with these private, let's say, angel investors or entrepreneurial people. And on the other hand, governments which maybe tend to be a bit more bureaucratic and so on. So how could this complementarity work? But I see you're not agreeing to what I said, because you're part of that business. And afterwards, I will hand over to Guntram. Did you want to say respond, Anna? Because I saw you didn't agree to what I said.
No, I do agree. I do agree. No, on the contrary, I do agree. I think they shouldn't be opposed, but I think that complementarity is important, and they're not crowding out. But I think when it comes to money investing into funds, it's a question of experience and knowing the market and being able to dose the amount. But flooding a market with money, whether it's EU money or any other money, it's important to think about the long term. I think when we're talking about risk capital, we're talking about an asset class that is an investment that needs to be done in the long term. So when a pension fund, an institutional investor, EIF or EBRD, or hopefully in the long term, more retail investors, if the regulation is in place, or banks, or etc., invest in risk capital, they're investing in a vehicle for 10 years. And so we need to think about this in the long term, and we don't want to throw money at funds, but not have some idea of the possibility to make money to ensure their own financial resilience in the long term.
Yeah, that's a very good point. So I have Guntram and then Caroline, please. So Guntram first, please.
Yeah, I mean, I just on this complementarity point, I would say there's really two essential elements to how to make this complementary. I think the first is the public sector intervening and funding specific projects, technologies, etc., signals a readiness of the public sector to stay in that market and to stay in that market also on the regulatory side. And I think this is really very important. Just take the green example again. One major risk that private investors in green technology face is that they don't know how committed the public sector is and will remain on the climate agenda in the coming decades. So uncertainty about the future path of carbon prices, to put it sort of in economic jargon, but also really on just the readiness of the public sector to underpin the green agenda in the next 2 decades is a major obstacle to private investments. And the more the public sector actually financially gets involved, the more it signals that it's actually committed to that. The second point, how this complementarity works is really that there are still information asymmetries, and some investments really are very, very risky for the private sector to undertake. And if the public sector goes in and takes the equity share, so to speak, the first loss tranche, I mean, then it really, it's a higher risk for the public sector, but it makes the investment much more easier to do for the private sector. And there, I have to say, this is something that's, when you explain this to a politician, it's always very tricky, right? Because, the public sector really makes most sense as an investor when it takes the highest risk share, because the other share, the lower risks, they can usually be funded by just regular banks, regular investors, and they are ready to do this. But it's the high risk where I think the public sector can play a role. And that's always controversial because politicians like to see these projects to succeed, right? I mean, they want to go there and say, okay, I've invested and I made a big profit, so I've been successful. But it's actually the exact opposite that we need. The politicians need to be ready to understand that you take a risk, and that risk taking means that you can lose actually, and you can make a loss on a specific project. But on the whole, you are actually advancing the risk-taking in the economy and thereby, the advancement in that sector. Let me stop here.
So just one additional question to you, Guntram. So how can the public sector decide which are the right projects? So are they actually able to do that?
Yeah, I mean, this is a very good question, and I think it's a super tricky question. When you talk to the European Investment Bank, they will answer, yes, we can. We have our people that have been in this market and have been doing this for a very long time. But I tend to agree with you that there needs to be a private sector assessment. So I think the way I would probably like this to be structured is that the public funding goes into some joint fund where there's a private sector assessment, but where the risk tranche, the first risk tranche, falls more on the public sector. And then there's lots of governance questions, I think, as you rightly point out, how you do this, because of course the public sector also doesn't want to be taken for a ride by the private sector. So you have to get the governance on this right. And I totally agree with you. This is the most tricky issue. I don't have a good answer other than that.
Okay, so let's ask the private sector, Caroline.
Yeah, I'm trying to take up the different arguments that were mentioned before and come again with my bold statement. It's about people and talent. So what I've experienced in the past 10 years when I was out fundraising, be it for startups, scale-ups, or for funds, I experienced that there are so many pools of money in the EU still that are not used as venture capital, growth capital investment. And that's a tragedy. Why is this the case? One is, and I'm taking up Anne's argument about regulation. So some of these banks, insurers, asset managers, pension funds have only limited ability of investing in these asset classes because regulatory-wise, they're not allowed to. So this is something that we have to change. But what is even more important in my view is that we pool and share the knowledge on how to assess the risk and not only risk, but also especially the opportunity of these investments. Because when you talk to the investment committee and the asset management committee of a large pension fund, a large insurance today, you rarely find people in there who have the ability to assess the performance, the future opportunity and risks associated with a venture capital fund investment. They've never done this before. They have no idea what to look for, how to assess this, so they rather keep their fingers off. And this is kind of like a vicious circle. So how can we make sure, taking up your argument, Guntram, that if the public money goes first, takes the higher share of risk, we need to make sure we have the right people on these investment committees to make the right investments for future-proof business models, to increase digitization, competitiveness, pro-climate, sustainability, social justice within Europe, so the future, right, of our economy, and that we share this knowledge on how to assess such an investment with the private sector. For example, there's no transparency in the EU of the performance of venture capital funds. It takes you ages to get an idea how well the funds perform. It's much better on, I think, private equity sector. It's much more transparent, but I think we can all increase that transparency because these pools of money that are there need to have, same as entrepreneurs, a much easier time to invest that money. So it needs to hit their KPIs that look at. They need to be able to report this to the regulators that oversee them, that this was good that they invested in that type of asset class. So how can we increase transparency, share the knowledge, and make sure the right people are in these investment committees to invest in the future of our economy?
Yeah, so thank you very much, Caroline. Actually, one point I wanted to ask you, because you're coming back again and again to the talent issue, which certainly is a very important one. So are you yourself kind of interacting with universities? I mean, and with the more the tech people at the universities in order to get them interested and to to make sure that they interact with the private sector, that they start thinking about startups and so on. Are you doing that?
Of course. So I think we have great universities already today in Europe that have these centers of excellence where they bring together the tech talent, engineers, software developers that come up with a great idea on how to solve a problem in a much better way and technology-based, and combine that with the commercial know-how on how to bring such an idea to a successful company. Right? That the last decades, Europe has been super strong, and we see this in the money flow in the R&D sector. We're amazing. We do the best R&D in the world, but we have such a hard time to commercialize this because it always smells a bit like, the Jeff Bezos like, Elon Musk like. But we need our Jeff Bezos, our Elon Musks in Europe that we can do our branding campaigns with to attract these people and bring these two sides of the medal. Right, great idea with a commercial mindset together to scale it and bring it to a huge success, a super champion that attracts talent, money, and creates revenues and new jobs. And there are programs, but it's on a small scale. And I've seen so many of them who start with that tech center and then actually go to the US, go to Southeast Asia, to attract the money they need, because deep tech needs a lot of money. So early financing rounds, already 2-digit millions, 3-digit millions, that right now in Europe is so hard to attract.
Thank you very much, Caroline. So actually, there's a question from my ECB colleagues to Marco, which is related to what you just said. So as of today, which are the tech hubs that you recognize in Europe? Is which ones would you name?
Okay, then probably Caroline may also jump in on this one and correct me. I see the kind of the two places which are clearly up and coming and very strong are Paris and Berlin as kind of as a larger ones, and then you have kind of more regional ones which still kind of are able to express technical excellence. Kind of in the Netherlands, for example, there are some new materials companies in the Limburg region, or so Munich, as well as some long tradition of biotech. So there are, as Karen said, I mean, the opportunities are there. Kind of really, it's a question of retaining these people and motivating them. And in the sense, kind of wanted to get back to this issue of talent, because we always talk about money, but I mean, in this sense, here we're talking about kind of talented money in a way, kind of money which needs to be managed by people who have the skills and experience to do so. And that also reflects to what Alain was saying before about the US experience. Yes, in the beginning, it was kind of a lot of public investment in the US, which helped create a generation of venture capitalists, because they basically practiced with a kind of little VC toy at the beginning, and some of them moved on and became successful. Okay, so here there is this issue of creating people who are able to manage, and this also reflects to what you were asking, Guntram, about kind of public institutions choose the right projects. Okay, my view is, and that is kind of you have great people there. With the public institution, the issue is more that of the incentives. Kind of what is the institution there to do? What are the rewards that somebody in a public institution gets? And there kind of clearly the risk aversion comes in, and I think that pretty much limits the ability of kind of being on the forefront. Otherwise, we would see that definitely. But I mean, this issue of kind of complementarity between financial and human capital, I think it is crucial, both on the side of the entrepreneurs and on the side of the investors.
Yeah, thank you very much for coming back to that point, which certainly is a very important one. So actually, maybe we can move a bit in the direction of regulation, and I have a question from Valentina Zadra from the Bank Association of Slovenia, and she asks, the EIF invests in various jurisdictions using its own terms and conditions, which frequently do not align with local laws, thus exposing local entities to legal risks and high legal costs. How about creating a special EU regime for these investment funds via a regulation? So I don't know who would like to comment on this point. Okay, so Anne, please.
Alain has gone, but I feel I'm probably closer.
So I called on you.
So what is important when we are aiming to attract capital to invest into a fund is to have a regulation that is user-friendly for the functioning of that vehicle. A fund is just a collective investment vehicle where a bunch of investors pool money together and a fund manager makes investments. But that vehicle has a bunch of duties and a bunch of functions. And the regulation around that, in order to be able to attract private capital, in order to mobilize capital, it has to be a regulation that is tried and tested and that is, I would say, user-friendly. And there are, and it has to be a vehicle that is pass-through and tax efficient. And I think from that point, there are a number of regulations that are more used and tried and tested than others. In Europe at the moment, one of the regulatory regime that is used is the one in Luxembourg. What would not be possible, and I think going to the point that many of the panelists have made as well, is that we're looking very often at regional vehicles. So if we're looking at a fund that can invest in Germany as well as in Slovenia, as well as in Italy, for example, the vehicle needs to address all of these different vehicles. So it wouldn't be possible to have separate vehicle per country. And we need to have something that is user-friendly in order to attract more capital into our regions, including in Slovenia, and it's a place, of course, where EBRD tries to mobilize money into.
Okay, so you said it should be user-friendly. So is it what we have currently, is it user-friendly, would you say?
I would say some regulations are more user-friendly than others, and some are more expensive than others. But I think what's important is that we all investors need to agree to use one specific set of regulation for each fund, and we couldn't possibly vary and pick and choose. The fund manager cannot change the regulation that governs its vehicle depending on its LPs. It has to have a vehicle that makes sense for the functioning of the fund.
Thank you. So Guntram also wanted to come in on this point, I see.
Yeah, thanks a lot. So I mean, I really like the question, because it is a question that sort of sparks a lot of imagination. And I've seen this kind of suggestion actually many times. I think it's called it used to be called the 29th regime. Now I guess it's called the 28th regime. So it would be sort of an attempt to create a legal framework that goes beyond the national legal frameworks, and ideally would be one that applies in all countries of the European Union. And I think the idea, I mean, there was an attempt to do this when one tried to create this European corporate legal status. And the problem was always that it didn't fully, it didn't fully go through, because there are so many implications of this. I mean, there's implications, first of all, and most importantly, on taxation. Once you create some sort of a European status, you need to define who actually collects the taxes and on what kind of basis. There's labor market implications, and the labor market regulations are still, of course, national ones. And then, of course, there's all other regulatory aspects where we still have lots. And I think, Caroline, you mentioned also the differences still that we have across the EU in terms of capital. I mean, not many aspects of regulation making cross-border activities so difficult. So my view and my hope is, I mean, I think as a sort of let's say long-term aim, I think it would be really what we need, and I think it would really become very, very interesting and attractive also for many companies that operate in more than one country. Once you create a really European regime on taxes, regulation, labor market regulation, etc. I mean, I think this would be extremely attractive for many companies. But I also think that at the moment, the political realities are such that it will be extremely difficult to advance on this because it means losing very concretely for any national political system. It means, losing out on the possibility to tax these companies, etc., etc. So I really like the question, but I think it's very far from where we are at the moment.
Yeah, thank you, Guntram. That's actually a pity that you're saying that, and I'm afraid I share that view, because it shows once again that we have still a huge potential in Europe to move forward, and we are simply not using it because we are not able to agree on common frameworks and so on. And I mean, this is probably the reason also why the whole progress on capital markets union and so on is taking so long, because every single point has to be negotiated. It's very hard to find agreements. But I think this is clearly an extremely important point. So let's hope that we are making more progress there, because in order to, advance in this area, we certainly need to do it. So it seems that Marco also wanted to comment on that point, or am I missing?
Yes, I wanted to complement this. I think that Anne before was mentioning it, the fact that there are a lot of kind of invisible or soft barriers to smoothly creating a European space. And this is true for, I mean, here we're talking about a lot about the investments, but it's also true a lot from the entrepreneur's point of view. Kind of if you want to clearly create a company which easily is created at the European level, there are often kind of what are called sometimes kind of non-tariff barriers, or this type of different approaches, supply chains, norms, which create some difficulty, and these are very difficult to overcome because they're less visible. But it's something on which investors or entrepreneurs may have to stumble many times. Even think about kind of the difficulties of enforcing legal contracts in different countries. This is kind of something which is when you have kind of a company at a very early stage, this can be very difficult, very, very penalizing. Okay, and that's also something which is very difficult to overcome because, as you say, it is a systemic effect which is almost in the nature of having a union, okay, which has some great richnesses, but also some pitfalls. And this is something which I'm quite worried about.
Yeah, so thank you so much for your comment, Marco. I would like to switch to a topic that was also mentioned by many of you and also by me in my introductory remarks, which is the relationship of the topic we're discussing today with the green transition. And I have a question from Michael Richter from the Bundesbank. How can private and public sectors join forces to speed up the green transition and provide European energy independence? And then an ECB colleague added the question, so what is the role of the EU taxonomy in all that? So who would like to come in on this certainly very important topic? So Guntram, you mentioned it yourself. So do you want to say a couple of words?
Sure. So I guess my first point is I really think this is a very important question because our energy dependence on Russia has, of course, major geopolitical consequences, and it's one of our key vulnerabilities at the moment. And so really getting this done, I think, is going to be so important, and is so important. It's really the top priority. So full support for the question. I guess then the question is how to do this, and I think I would probably distinguish between sort of the warlike economy, where I think in the next half a year or 1 year, we really have to pull everything together and all levers because this is just such a dramatic geopolitical situation. And that means also, to my mind, probably some rationing of energy in some parts of our economy. And so this is basically what I like to say something like almost like a warlike economy. So this is one agenda. But I think the question was more about sort of the greening and how to do this. And the greening, the problem with the greening is it's not going to happen in the next 6 months, right? I mean, this is an agenda which I think can be massively accelerated. We have green technologies that are already cheaper than fossil fuel alternatives. But the rollout cannot happen in 6 months, but it can happen, I would say, in a 3-year perspective. You can do a lot. And so there, I think the funding will be key, absolutely. And so there, I think, again, coming back to my earlier point, I think we need the commitment and the credible commitment of governments to actually do this and stand behind it. And so if I'm a private investor now, what I really need to know is whether, this agenda of getting rid of Russian gas is going to be reversed next year if the war is over next year or not. I mean, suppose the war is over next year, will gas again become the dominant energy source or one of the most important energy sources, Russian gas? Or is this actually a credible commitment for the next, for forever, that we move away from this gas? I mean, it's this kind of uncertainty that I think really probably holds back the private investment at scale at this stage. And so investor uncertainty is absolutely key to my mind.
Yeah, I would agree to that. I'm not so sure I would agree on that the uncertainty in this particular area is actually that large. So I think the political commitment in this area is actually quite strong, and it has, at least in Europe, unfortunately not in all parts of the world, I think even be reinforced by the current situation. So my feeling is that actually the commitment is already quite strong. But I don't know whether anyone else would like to come in on this. And actually, I think, Guntram, you also made an important point earlier on, which I also fully share, which is this fact that we kind of, Europe is quite advanced on this greening issue. But given that sometimes we tend to be a bit slow, there is a risk that at some point we're going to lose this advantage that we currently have. And of course, this would be quite a lost opportunity. And I really hope that we can avoid that. Maybe you also have some views on that. So Anna, I see you want to come in.
Yes, I think I would like to come in on this. I think that actually Europe, in terms of private equity generally, is ahead of the US in that field in terms of aligning the incentives of funds to the green agenda. I think that the whole private equity world in Europe has been considering these aspects for many years already, whether they are aspects that US firms are starting to look at now. So I would say on this one, I think we win. And I think both private equity, the larger player in private equity and venture capital and the more innovative aspect has definitely a huge role to play. And this is an industry that is perfectly well adapted to accelerating the green agenda because the incentives that are created between the enterprise in which the fund invests and the fund value adds are really exactly there to accelerate on this. So I would say it's an opportunity even for private equity to do this. And so you mentioned earlier that I'm currently chair of Invest Europe. Invest Europe is doing a huge amount of work on this with the data collection and soon the definition also of ESG standards. And with my EBRD hat as well, we have a huge commitment to having the vast majority of our portfolio to qualify as green. And here I think I also want to say, the Invest Europe ESG reporting standards are going to be quite important because I think we see a lot of titles about green investing and greenwashing, etc. So it's very important that we are rigorous in our analysis of what is green and what is not green, so that we are able to be successful. So I would say I think we should congratulate ourselves. I think we're doing quite well in Europe. It doesn't mean that there is still not a lot to do, but we have a head start, and I think if we continue with the momentum we have, the whole private equity industry can definitely accelerate this agenda.
So I very much like that positive message that you're sending. And actually, Philip Hartmann has a comment in the chat saying that, of course, in a Next Generation EU also has this very large green component, which adds to this commitment aspect that was mentioned by Guntram, who's somehow disappeared from my screen. I hope he's still there, actually. So actually, we are already coming. Oh, he's back. So we are coming to the end of this session. Unfortunately, I think we could have gone on for a long time, But I would like to give each of you the chance to maybe just say what you take from our discussion, because I think we discussed many relevant points. Unfortunately, not all that I would have liked to discuss. But if you want to stress one or two things that you find particularly important, I would be very happy. So let's go in the order that we had initially. So let's start with Caroline, please.
Thank you so much, and I really enjoyed the discussion. I must say, we all agree that we have a massive opportunity, and we just need to make it happen, which I really enjoyed because it could have been different, right? So let's do what is needed to attract the talent we need to create innovation that fuels economic growth and makes the digital and green transformation happen in Europe.
Thank you so much, Caroline. Anne.
I would like to say that I think even though it's fragmented, Europe is a incredible zone of opportunities for us to achieve many agendas, including innovation, including green, including also diversity. We didn't get a chance to discuss how we can accelerate this further with various regulations, but I think it's a fantastic opportunity, and I do think that this public-private partnership is something, if it's well tuned up, can be a wonderful accelerator to achieve our common goals.
Thank you very much, Anne. So Marco, you're next.
Yes, I thought that I take out of this is that I mean, there are a lot of difficulties, and we have not talked a lot about this, but it was underlying what we said. I mean, many of these difficulties also arise from the political process, challenges. Okay, and we see that, for example, the recent Ukraine situation and before COVID, they have created so much progress in European policies, which had stalled. Okay, so in a sense, now we have reacted very well to external challenges. Okay, so in that sense, kind of there is, I see this kind of both the challenge and the opportunity. So in the sense, as Caroline said, kind of it's a lot in our hands to take it up and make it happen, because we have the capability and the opportunity and the strength to do this. But it's not kind of just an easy stroll in the park.
Thank you very much, Marco. And Guntram now.
Yeah, I mean, also to say I think it's a great opportunity, and I think it's very important the kind of thought leadership that comes out of the European Central Bank and Isabel. I think it's really great that you put all of these topics really forward, and I think it's important to have this debate. Perhaps the one point I would add is I think it's really quite important to get this as broad as possible societal debate. I mean, this cannot be just a sort of an elite debate or an elite debate in Frankfurt and Brussels. I mean, we need to carry people along, and this is I think where the big challenge is, and I think this is where I would put some emphasis on in the future. So thank you so much for this great debate.
Thank you so much, Guntram, also for your kind words about the ECB. So I think actually now it's time to close the panel. Let me just mention, because I couldn't see it in the chat, but the ECB colleague who asked all these interesting questions was Francesco Mongelli. But just to conclude, so let me say, I think we had a very important, very interesting debate. I think the key issues were the complementarity between public and private finance, and how to make sure that the two complement each other and don't crowd out each other. The second very important one was the complementarity between capital and other aspects like talent, entrepreneurial spirit, and culture. Then finally, the aspect that is, of course, very important, in particular in the European context, which is related to regulation and harmonization. So kind of going beyond national regulations, but having a more unified framework. I think all of us can contribute to moving this important topic forward, be it as entrepreneurs, as policymakers, or as thought leaders. So thank you very much to all of you for doing this and continuing to doing this, and of course for joining me in this fantastic and so interesting panel, which was attended by around 200 people who I hope enjoyed the panel. Let me hand over to Philip Molitor now. Thank you.
Thank you.
Thank you very much for this interesting discussion. We will now break for 1 hour, and we will resume here at 13:30 CET with the keynote speech of Commissioner McInnes. So have a good break and see you again at 13:30. Thank you. the afternoon session with a keynote speech by Commissioner Mairead McGuinness. Before handing her the floor, I would just like to recall that you have the possibility to ask questions to Commissioner McGuinness after her speech. For doing so, please write them in the chat or write that you would like to ask a question to get the floor or raise your virtual hand. And again, without much further ado, I hand over to Commissioner McGuinness. The floor is yours.
Well, thank you very much, Philippe, and good afternoon to you and indeed to all colleagues joining in this event. Very happy to be with you and, of course, to take questions and comments afterwards. I'm going back in history to 65 years ago when the Treaty of Rome was signed, laying the very foundations for today's European Union. And at that very beginning, the founders set out the building blocks for a common market. And that was based on what we know, the four freedoms: goods, people, services, and capital. And really, we have spent the last 65 years working to integrate Europe and European financial markets, step by step, but based on those very four freedoms I've mentioned. So 22 countries joined the original 6 signatories, but as we know, one country has since voted to leave the European Union. And over that history of 65 years, we've had crises, we've had missteps and failures along that journey. But there has also been considerable progress and determination to continue to build a better European Union. And I think we have learned from our mistakes, and sometimes that is the best learning. Because you hopefully will not repeat them. So a more financially integrated European Union means that companies have more opportunities to get funding from a variety of sources. It means also that investors have more opportunities to invest in the whole of the single market, not just in their home member state. And of course, for consumers, there is greater access to more products and services from different providers. And really, I want to thank the team at the European Central Bank and the Commission for organising today's event, perhaps even more timely given the geopolitical situation in which we live. So if I look over the last decade, we spent a lot of time, and rightly so, responding, if you like, to fixing the things that we got wrong in the past, or indeed that went wrong in the past. So now is the time to look ahead, in my view, and build a financial system for the future and for that sustainable future that we're all trying to build. And one of the main ways we can do that is by deepening the Capital Markets Union, which also means building up key financial infrastructures within the European Union, in particular our central counterparties. So already a new European financial landscape has emerged, and it is continuing to emerge. After Brexit, a multi-hub structure replaced a system focused on just one city. The European headquarters of many financial firms have moved to Paris, Luxembourg, Dublin, Frankfurt, Amsterdam, Madrid, Milan, to name a few. And not all parts of the industry picked the same new home. Many banks went to Paris or Frankfurt, while asset management companies chose Dublin or Luxembourg, and indeed Amsterdam saw an increase in trading. We've seen one large finance cluster replaced by several, and each has a clear focus on a particular activity in the financial system. So as EU policymakers, of course, we monitor these shifts very closely, especially their potential impact on financial stability and indeed financial integration in the European Union. So let me talk about this issue of financial stability. And here we have to ensure that financial service providers and key financial infrastructure fall under our own regulation. And that isn't just because we believe our regulation is necessarily better or more sophisticated than in other jurisdictions, but rather because when these activities are there to serve the European economy and European citizens, it's our duty to make sure we have European oversight. So the multi-hub structure also challenges us to think hard about what financial integration actually means, and in particular in a digital era. Today, the focus is no longer on establishing links towards one financial centre. So instead, several centres need to be connected to each other and into the economies across the 27 member states and local systems. Financial integration doesn't necessarily require a central market for an entire currency area. And a clear example is the US, where finance is spread across various cities, including New York, Chicago, Boston, and San Francisco. So in the EU, it's the Capital Markets Union that can help that multi-hub structure work as a coherent whole. And it has many other benefits too. A strong Capital Markets Union is really vital to sustain the recovery from the COVID crisis, not to mention the impact of the war in Ukraine. It can also help mobilise the enormous investment needed for the green and digital transitions, including the digitalisation of the financial sector. So a genuine CMU, Capital Markets Union, will help fintechs to raise the capital they need to grow and scale up their activities within the single market. And that's why the CMU project goes hand in hand with the European Commission's digital finance strategy, which aims to harness all of the opportunities offered by the use of technologies in finance, while also addressing the risks to financial stability or investor protection that these technologies can pose. We also need to broaden opportunities for individuals to save and invest over the long term, and I'm really determined on this. All in all, the Capital Markets Union will foster a more inclusive and resilient economy, which we need more than ever in these turbulent times. So let's look back. When did we start real work on CMU? Well, that was 2015. And the idea was to make the free movement of capital, part of the original vision of the Treaty of Rome, a reality. Our first Capital Markets Union action plan has delivered concrete results, like regulation on SME listings, a framework for simple, transparent and standardised securitisation, revised rules for venture capital funds, and an EU-wide regulation on crowdfunding. I think the departure of the United Kingdom from the European Union has made these efforts even more important. We needed a European response to maintain an efficient, safe and integrated financial system underpinned by financial stability and strong supervision. So we adopted a new CMU action plan in 2020 to step up our work. And last year, we tabled a number of really ambitious legislative proposals to see that plan put into action. For example, to address the shortcomings in the trading and post-trading landscape, the Commission tabled a proposal for a consolidated tape to remedy the issue of fragmented trading data. And we tabled another proposal here to better integrate the market for settlement services. And work is also ongoing to make capital markets more accessible to citizens. And this includes work on financial literacy, pensions, and an ambitious retail investment strategy. And the Commission is laying the groundwork on more complex structural issues which need to be addressed. And these are the ones that cross-border investors often identify as the root cause of fragmentation. They're also politically more difficult. And I'm talking here about corporate insolvency and withholding tax as examples. The Commission is working on targeted action to address divergent rules in these areas. For example, just last week, we launched a public consultation on the issue of withholding tax. And we do aim to come forward with legislative proposals in these areas next year. Now, to succeed with the CMU, we need the right supervisory framework. The European supervisory agencies need strong supervisory convergence power to allow financial centres to compete on their respective merits. And our supervisory framework should be balanced. So it must take into account the need for a level playing field for financial firms operating within the single market across borders, while allowing national competent authorities to take into account the characteristics of their own financial ecosystems. And in the coming months, as was envisaged in the CMU Action Plan, we will report on the functioning of the European supervisory authorities. And this report will also assess the need for more harmonisation of our rules at EU level and also to monitor progress towards supervisory convergence. I would say that CMU is a long-term project. And by the end of this Commission's mandate in 2014, I want to see tangible progress in the integration of our EU capital markets. And that is even more vital if we consider the geopolitical context and the need to step up our investments in renewable energy and sustainability more generally. The CMU is key in supporting the international role of the euro and our open strategic autonomy. And open strategic autonomy is vital if we are really serious about Europe's resilience and Europe's global leadership. It is about standing on our own 2 feet, about being confident of our place in the world while remaining open and competitive, because we benefit from openness and competition. But I think here we shouldn't be naive. We do need to watch out for areas where we are vulnerable to decisions that are made outside the European Union and therefore beyond our control. So energy is the most prominent and urgent example of that vulnerability right now. But we also need to watch for vulnerabilities in capital and financial services. We need our financial markets infrastructure to be resilient. Let's just look at the market turbulence for commodities and commodity derivatives in energy, agriculture, and raw materials due to the war in Ukraine. So this brings me now to the EU's clearing agenda. This is a market segment that is very technical, operates below the surface, but it is critical for our capital markets to actually function. And I think we need to be clear that a systemic problem in clearing would be a problem, and potentially a very big problem for all of us. And that is why we put in huge efforts to ensure the financial stability of EU financial market infrastructures, in particular central counterparties. Well-developed and resilient CCPs are key for capital markets to function well. They support trading and ensure good management of risks that stem from derivative trading. But we are still too dependent on some clearinghouses beyond our borders. And that's a concern because of just how vital CCPs are to the entire financial system. If there are major stresses in CCPs, then there would be a significant risk to financial stability. And EU regulators wouldn't be in the driving seat for any decisions that would be fundamental to European financial stability. So the EU needs reliable arrangements for central clearing that serve EU interests in all circumstances, not just in fair weather. Third-party CCPs, particularly those based in the UK, are important for EU market participants. But I need to state very clearly, we are over-reliant on UK-based CCPs. And this current position of the EU being heavily dependent on a third country for clearing is unprecedented, and it's not sustainable in the medium term. We do not rely this strongly on other jurisdictions in any other area. It is a risk for the European Union, and that risk must be addressed. So I'll go back to last February. We adopted an extension of the equivalence decision for UK CCPs for 3 more years. So that's until June of 2025. I think rightly we announced this extension early, avoiding potential risks to financial stability if EU banks abruptly lose access to UK CCPs. Again, really important for financial stability in the short term. But in the medium term, we need to build up capacity in the EU and reduce our overdependence on UK-based CCPs. Again, as I said, it's vital for financial stability. But central clearing capacity is also an important dimension of the Capital Markets Union, those deep, liquid, integrated capital markets that we're working to build through our CMU action plan. I think we cannot be serious about Capital Markets Union without competitive critical infrastructure in the European Union. And for those reasons, we launched a public consultation, and that consultation asked questions. So how to improve the attractiveness of EU clearing landscape, and how we would encourage infrastructure development, and also reform supervisory arrangements for EU CCPs. The consultation has just closed 2 weeks ago, and we received more than 70 responses, and those responses will contribute to our reflections. And again, our appreciation and thanks to those who actively contributed by putting forward ideas and feedback. There are various options to achieve our goal of developing clearing in the EU, and over the coming months, we will assess what's the best in terms of those options. We may need initiatives targeting both the demand and the supply of clearing services. So on the supply side, for instance, we may look into how to encourage a broader offer of services by EU CCPs. We've listened to stakeholders, and we hear from them that it can be easier for CCPs in other jurisdictions to expand their business than it is for CCPs in the European Union, because in the EU they need to go through much longer and more complex procedures. Now, if you look at the demand side, we're also assessing various options, and they range from measures to disincentivize clearing in systemic third country CCPs to measures imposing more specific obligations on market participants to increase the share of clearing in EU CCPs. And in the consultation, we asked for views, for example, on the possible role of bank capital requirements in favouring a reduction of exposure to systemic CCPs, or the possibility for clearing members to have an active account at an EU CCP, We will look into how best to achieve our goals of reducing over-reliance while also boosting our own competitiveness. And I think really importantly, we will also assess how to ensure that the supervisory framework for EU CCPs is robust and fit for the future. And the Commission will look at how to improve the efficiency of supervision in view of a deeper EU clearing market. So if the European Union is to increase capacity for central clearing, then the related risks must be appropriately supervised within the EU. And we plan to come forward with a legislative proposal on our clearing agenda in the second half of the year. So, as you've heard, we have big ambitions for the European financial system. We have huge opportunities because we have an incomplete single market for capital. It is important that the 65-year-old promise of the free movement of capital is finally met, that the financial system remains and is fit for the future, and that future will be both green and digital. And in one sense, the future is here and now. Brexit, COVID-19, and the ongoing war in Ukraine are reminders of our vulnerabilities and the need to build a more resilient European economy, which is vital for people and businesses in Europe. But it's also a big part of why Europe is strong at the global level. I want to stress that a resilient economy relies on a resilient financial sector. And the Capital Markets Union will underpin a strong and resilient financial system in Europe and one that is fit for the future. The CMU in turn will be underpinned by solid market infrastructures, including CCPs, which is why our clearing agenda for the coming months is so vital. I look forward to working with all the relevant stakeholders and to engage with you to make our ambitions a success. So thank you for your attention. And I look forward now, I think, to both comments and questions. Thank you.
Thank you very much, Commissioner McGuinness. And questions are coming in, so I can give you the first question from Krzysztof Adam-Gorski, who asks, having in mind the EU resilience, is any significant equivalence decision for financial institutions by the European Commission feasible in the foreseeable future?
Well, I think that all our decisions are based on a careful analysis of financial stability and what is best for the European Union. I think that question is terribly broad, so we could, go in all sorts of directions. But if we bring it back to that core objective, which is embedded in my title, which is financial stability. But equally, I am obliged to try and progress banking union and capital markets union. And therefore, we require ourselves to do a critical analysis of our financial infrastructure, our financial system, and check for vulnerabilities. And in one sense, we've learned the lessons of COVID, and indeed we're learning hard lessons today with the horrors of the war in Ukraine, that we do need not to take for granted that our systems in place today will be the systems that will sustain us for the future. We have to look forensically at every component of our financial system and to see where the vulnerabilities lie. For example, we're looking through our proposals on DORA about operational resilience, about cybersecurity issues. So in a sense, to the answer I would give to that very broad question, we look at financial stability. But I do think, particularly in these times we live in, none of us can be complacent. Whatever sector you're in, finance, food, manufacturing, everyone needs to think about resilience, vulnerability, and we also need to have the wherewithal to address vulnerabilities where we identify them. And I think in my opening remarks, I have identified areas where I think we are vulnerable and why we need to take action.
Thank you. Now moving on to the next question. My colleagues just put on the screen, and exactly. Can you tell us a bit more on the type of incentives you have in mind to enhance the attractiveness of EU central clearing counterparties?
Okay, maybe I'll start by saying something that might surprise you, but I think it's important to understand that there is some resistance to change because people would say, today the system works, why would we change it? I can understand that, and I've listened to stakeholders who would say that. But on the other hand, when I explain what my agenda is, there is an understanding of why the European Union needs to strengthen our infrastructure. I don't want to be too specific on the buy side and sell side, but maybe just some examples, because remember, we are analysing the feedback we've received from the stakeholders. So there's no detail in which I will address now that we're definitely going to do, but I'll give you examples. For if you look at the pensions sector and other entities, perhaps having a requirement that pension funds and others would clear at EU CCPs, that could build more liquidity in EU markets. Maybe also that national and public entities would also clear in EU CCPs. So those are some examples of where we might look towards, but there will be many others as well in relation to addressing the difficulties, because as I've said, and I'm very aware of this, that when it comes to moving, the markets resist movement because they are obviously afraid of extra cost and maybe disruption. We have, in my view, addressed the concerns around disruption by granting this longer equivalence period, but in that same timeline, looking at all of the details as to how we would manage the movements towards a stronger CCP within the European Union. And it is about trying to make European CCPs more attractive. I think on supervision, there is a sense, and I believe an awareness, that when we move in this direction, we need to have stronger European supervision. So in my view, that's also a critical part of the conversations that are being had at the moment. So in a way, we're looking at both incentives. Positive ones would be better than negative, but we're very open. So at this point, I don't want to say exactly what we would rank in terms of order of what we would do, but to say that we have got the feedback. We are aware of where there are difficulties. We know that had the United Kingdom remained part of the European Union, this would not be a discussion point at all, because London would remain part of the European Union's financial infrastructure. But now that they are gone, and it happened in 2016, it is really time now for Europe, the EU of 27, to make very strong decisions on financial stability and the financial system, just as we are doing today very critically and very urgently around our dependency, our over-dependency on energy from Russia, for example. And indeed, just as we learned during COVID that we were very heavily dependent on some partners, trading partners, for our medical supplies. So I think while the sectors are different, the lessons are the very same, that you need to keep checking for vulnerabilities and really be very careful to avoid any, in my case, financial stability risks. I mean, ideally, I would like this work to happen faster, but I'm also a realist. I do understand that it cannot happen, for example, fully within the mandate of the commission I currently serve with. But I would like to think that I would have, with my colleagues, a lot of the heavy lifting done, so that when June of 2025 comes online, that we're ready, that the system will have a smooth transition, and that we will not only have stronger CCPs in the European Union, but that our work on the Capital Markets Union will advance. And I think that's really important now because of the urgency of driving more rapidly towards investments in renewable and a more sustainable economy, including digitalization.
Thank you. And here comes a question I think that nicely fits. What is the calendar for announcing these measures that you were talking about?
Okay, the calendar is we've already done the consultation, we're looking at it, and by, I think, October, if I'm correct, of this year, we will be coming forward with some proposals. So it's quite a short timeline, but you know how we need to propose, and then, of course, we have work with co-legislators. So that's the timeline we have in mind. It means that the work now is really critical before October, and indeed before the summer months, so that we carefully analyse. And we won't just look for the good pieces in the feedback we're getting from stakeholders. We will look at the entire package so that we do come up with a balanced proposal that actually will work. The test of our debate now, the test of the work we're doing, will come in 2025. But really, it will come before that, because I think we will need to see movements based on the proposals we will have on the table. And already, if I speak to EU CCPs, they are looking, thinking, wondering, and trying to see how they can upscale. I don't underestimate the challenge. This is a challenge that we didn't invite on our plate. It happened because of a decision of the United Kingdom. It's also really important to stress, while I have a chance, that this isn't about us trying to take a business from the United Kingdom. Sometimes that's if you like, how it's read by some in the financial system. But rather, I see this potentially as a win-win for the United Kingdom and the European Union. I don't think it would be healthy if the European Union is over-reliant on any third country infrastructure in the financial system. I think a stronger European Union, a stronger capital markets is good for global capital and global capital markets. And I think and hope that our UK colleagues will understand that. And I dare say if it was the other way around, that the UK would obviously want to strengthen its own internal systems. And of course, we have to deal with reality. London was the centre of our financial system for as long as the United Kingdom was there, and indeed benefited from that engagement. But the world has changed. And indeed, in recent years, and even as I speak to you, the world is changing dramatically. None of this change is easily, it's fragmenting. It's causing a lot of tensions, not just in our financial system, but equally in supply chains. And it's causing, I think, internally in the European Union, the member states to realise that actually for some of these big challenges, acting alone won't work. And that unity, even if it's difficult, is really important to tackle those big, big challenges. And I think one of the big challenges, which is not just important to do, but also will give great feedback and results for Europe, is to deepen our capital markets union. So I think on this, it's a win-win.
Thank you. And we're actually getting here a number of questions on asking how will more clearing volumes in the EU strengthen the CMU and single market in financial services?
Perhaps just to repeat maybe some of what I said internally in my opening remarks here. I mean, let's go back to the way we were. We haven't developed our capital markets union. We had a very strong member state that's now not a member state with strong infrastructure. We want to deepen our capital markets, and I think we want to deepen them now, particularly around green and digital. And there is money there that can be harnessed for investment. So then you need to look at where are our vulnerabilities. And we have done that analysis, and we believe that around CCPs, there is an issue. But it was an issue we identified early, but we made the right decisions. So we gave equivalence, and rightly so, for 1 year when the United Kingdom actually left the European Union. And then we took time to look at 1 year was certainly not enough for us to build capacity internally. So we have made that other decision. And we believe in order to deepen capital markets, first of all, you know, these infrastructures would be European and European supervised. That's important to us. And I think the point is perhaps best summed up by, you know, in fair weather, when it's not raining, you don't need an umbrella, but you need one close by in case it does. And I think for me, it's not so much the work I do now as commissioner in this area, it's the work I do now looking to the future. What if something happens? Where would we be vulnerable if we take no action? So if we grant, you know, an unending equivalence, what are the risks to our financial stability should things go wrong? Now, people will say, oh, they won't go wrong. They haven't in the past. You know, things have happened globally that we never thought we would see in our lifetime. Tragically, some of them going back to the worst times of history. And I'm obviously referring to the Russian invasion of Ukraine, but equally around a pandemic that we thought might happen, we didn't really take it seriously. So I think you have to look, at least I do, and the services have got to look beyond just today, or indeed tomorrow, to see what is best for us in the future. And we've done all that analysis. And even though it might be difficult, and we will meet resistance, for example, some would say, why have you only granted 3 years? Why are you saying it ends then? And the reason I'm doing it is I want to be very clear and honest with markets. I want to say quite clearly, this is our plan. We want you to be part of it. And I'm articulating the reasons why we have put this plan in place.
Thank you. And next question comes from Kaspar Köchli. Thank you so much, Commissioner McGuinness, for your insightful remarks. With regard to financial stability and finding a balance between full implementation of globally agreed standards and the need to reflect the specificities of EU banks, how is the Commission planning to move forward? In particular, the Basel III framework after the ECB emphasized the EU implementation should not deviate too much from the agreed framework.
Okay, this is a question which was raised with me in my hearing some time back. So it's obviously a very key question for the banking sector and indeed for clients of banks. And the message and the agenda to which we are working and our proposal is based on, first, is faithful implementation of Basel. And that's important for our banks to know that we are strong enough that we are capable of implementing. But with that, being conscious of European specificities. So what are the peculiarities of our systems across the member states that we need to address? And that has been done, in my view, in relation to the proposal that's on the table. And of course, everything will be influenced, I'm sure, when the debate opens in Parliament and Council about the current scenario that we live in, the background in which we are. And that's why the proposal deals with all of those things that are particular to the European banking system, notwithstanding that we still have some member states who are not convinced of all of the proposals that are there. And I'm awaiting feedback from both Parliament and Council. But I was very clear again, as I was in the previous issue, that what we're talking about here is getting the balance right, so that we don't allow ourselves to be seen to deviate from an international standard that we signed up to, but that we're not naive either, and that we ignore our own particular interests and needs, so we deal with the specificities. And I'm be interested maybe with some feedback. Clearly, some will agree that we've got the balance right, others will disagree. And I suppose that is where the process now is, to see how will our proposal be amended, or indeed will it be significantly amended? But we would stick to our view in the Commission of the balance that is required. And while I mentioned that in my hearing, this was a very hot topic, and before indeed our proposal, this was an area where we got a lot of engagement, and rightly so. I think since then, people are analysing. There's less, if you like, deep engagement, because there's an understanding of the motivation behind our package, which is all about balance.
Thank you. And being mindful of time, I have here a last question. Does the Commission consider providing support for companies in EU member states affected by the Ukraine crisis and sanctions implemented in response?
Well, look, I think what we're all doing at the moment is trying to watch the impacts. Now, our sanctions are designed to tackle and hit the Russian war machine, so to make sure that this war is not prolonged. It's also a clear reaction to what is an illegal invasion. And indeed, if you look at the recent days, the horror of what is happening on the ground, and we may only come to learn of more atrocities in the days and weeks to come. So our reaction was to hit hard with sanctions. We try and make sure that those sanctions don't hit hard on sectors in the European Union, but there are impacts. And the first point to be really clear on is that, this is a big hit to the globe, because we see a situation where democracy is under attack. I think that our people, our citizens, understand that there will be pain. I think our businesses already understand and are taking pain. For example, some of them are deciding, without being sanctioned, that they should leave Russia. They should not continue to invest. So there's a lot of de-risking, of people deciding for all sorts of reasons that they do not want to be associated with the Russian economy. To the point of the question, can we give supports? I think this is down to member states identifying if there are particular sectors impacted in a very severe way. We need to address that. There are possibilities within the state aid framework. So this is something that I think will evolve over time, and we will have to adjust over time with whatever comes from not just our work on sanctions, but clearly there are, if you like, carryovers from COVID. There will be impacts of the war, nothing to do with our sanctions, but clearly there will be supply chain impacts because of the invasion of Ukraine. And I think the one thing that's very striking, and I'm sure others have also come to this observation, the interconnectedness of the world up until now, the reliance and indeed over-reliance in some areas, the realization of our lack of resilience, of our vulnerabilities, is now very starkly in front of us. And I think those companies that are impacted will probably also be looking at their future in the way that many are looking at their future because of the climate challenge and trying to address vulnerabilities around climate and environmental issues. So we remain open to the question you raise, to being very careful to monitor any impacts. And I think member states will also keep us very closely aligned with what's happening on the ground. And where there is need for action, that action can be taken. We have a range of tools that will allow for that. But it isn't to say that every sector that takes a hit will receive compensation. That is not the case. As I said, pain will be there for both citizens and for businesses. And it is a question of how resilient businesses are and will be to this reality of not just our sanctions, but to the wider reality that we now have a very fragmented world, more fragmented than in the past. And even should this war end soon, which we all hope it does, you know, there will be a different mindset in Europe and I think elsewhere. We talk about open strategic autonomy. I think it's now even more important than before this invasion. And I think it's right that we do not allow companies suffer unduly. So I think that's where I would really mark this issue, that those sectors that are really being hit through no fault of their own certainly need some support. And there are various tools available to us to provide that.
Thank you so much, Commissioner McGuinness, for your keynote speech, for sharing your views with us. I think we close it here, so thanks again. And we will then turn to the next panel session. Could a decentralized EU financial sector achieve a more financially integrated EU financial services market? The moderator of this panel will be Peter Grassmann, Deputy Director, Financial System and Crisis Management at the European Commission. And I would now hand over the floor to him and his panel participants. Peter? I suggest otherwise just to introduce already the panel participants because most of them have joined. So part of the panel is Magdalena Borowik. She is a Senior Advisor for Innovation at the Polish Security Printing Work SA. I don't know, Magdalena, maybe you can switch on your camera. Hi there, good afternoon. A second panel participant is Leonardo Gambacorta. He is Head of Innovation and the Digital Economy at the Bank for International Settlements. Leonardo, good afternoon. And I see Peter is online, so I would hand over to him now.
No, Philip, why don't you finish that job by introducing the panelists? I'm very grateful.
Good, Peter. Then the next one on my list is Paul Klanczek. He is the Chief Executive Officer at Bitpanda. We have Peter Koblic, President of the Federation of European Securities Exchanges and the CEO of the Prague Stock Exchange.
Hello, nice to meet you.
And the last one, I have been told that Monique Goyens, who was on the panel, couldn't make it last minute. I think she has been replaced by a colleague at her institution, but probably you have the name, so I would kindly ask you to introduce that colleague. Peter, the floor is yours.
Thank you very much, Philip, and welcome also to Brian Coughlin, who took the difficult task of stepping in very late and last minute for Monique, who was unfortunately hindered this afternoon. I'm excited about this panel. I'm excited about the high quality, the diversity about this panel. Excited about what we try to do, or what I at least would try to do, to achieve in this panel. Maybe, okay, what is the title of our panel? Just to recall it, it's called Decentralized EU Financial Sector, Achieve a More Financially Integrated EU Financial Services Market. Long title, but clear. So we are now drilling down a bit on what already the Commissioner McGuinness sort of like raised in her keynote address. It's like the spatial allocation, if you wish so, of financial services provision in the European Union, and its relationship to financial integration. Clearly that financial integration and particular capital markets integration in the European Union is more important than ever. It's easily said, but I hope you follow me there, in particular against the backdrop of what we see elsewhere, a bit signs of fragmentation of the global financial system. Still, the EU still digesting, and the Commission alluded to that a lot, the departure of the United Kingdom and its financial markets from the European Union. So we have to further work on integrating our capital markets in the European Union, make them deeper, make them more competitive, make them more efficient and resilient. Does that all go together? And within that context, the question that then what is sort of the structure, the spatial structure of EU capital markets was fairly easy before the UK left. There was one prime financial center, London, and below that were some smaller centers, and then the overall structure sort of like hierarchically linked up. That has changed, obviously. A lot of migration has happened, as the Commissioner explained, not to one place in substitution, but to a number of handful of EU financial centers, which has to be seen. Now, the debate had, since the past 5 years, a bit typically has been concentrating on a binary choice. Is it better or is it worse to have more than one center or a fully centralized center? What is it? Is there a net loss of efficiency in EU capital markets due to this now more diversified multipolar center? In this panel, we would like to try to go a bit beyond that and sort of factor in that discussion the ascent, the arrival, the impact of new technologies, which might call for a more nuanced view and a new nuanced stance on that issue. I guess if you start thinking through what new technology does to integration, to the chances of integration, it depends a bit. It depends on what kind of technology, what kind of market we talk about. And I would, however, leave all that talking to our illustrious panel. They are the experts, much more so than I am. Just maybe to bring back or start at the start of the panel, like focus, reminding us of the 3 key issues we would have in mind, which we should a bit drill down on. On the technologies. Which are the key technologies which are relevant for financial services in the future? There are many, but what do we have to particularly look at? And what are the risks and opportunities? And then secondly, the impact, the relationship of these key technologies with financial integration of the European Union. Neutral, positive, negative, depending on what. And thirdly, a bit, if time permits, the policy or the regulatory component to that. Are there implications of the changing landscape due to technology? What are the implications for our supervisory regulatory framework? And importantly also, what about consumer protection? Now, the panelists, I thank you all for having made it today. You were hopefully duly introduced by Philip. So I would now suggest that we start the panel by each of you sequentially, giving an around 10-minute introductory statement. You can do that with or without slides. And I would ask first Peter Koblic to start off, unless there are any protests against all that. Peter, the floor.
I hope there are not. I hope there are not protests.
Very good, Peter. Then the floor is yours.
Thank you very much for inviting me for the panel. And thank you, Peter, for this introduction. By the way, I think you can call me Peter. Peter is just the Czech translation of the same name as you have. So yeah, thank you very much. I think it's very interesting. It's very interesting topics, and the topics where a lot of the people, especially vis-a-vis the technology, tend to overrate some of the views and some of the angles we have. But first of all, I would probably go to the title of that panel. We just heard from Commissioner McGuinness as she was speaking about deepening capital market union, and I couldn't agree more. Actually, we do need capital markets union to be deepened. To be deepened the everything which we can make on the similar platform or on the similar rules. I have to stress we have to put the special focus on the primary market. I think actually the secondary markets in Europe are pretty much consolidated, and especially for the blue chip companies, there's relatively easy flow of the capital around markets, with one exception, and I will speak about it later. But where I do think the markets are still very much national, and it's very difficult to go for the multinational primary markets or IPOs, if you want. I think there is a consultation now on the Listing Act and also Prospectus Directive, which was a very good step a couple of years ago. I think we have to go much further. I cannot come with a single reason why the new technology company going public in Spain cannot be easily distributed to the wealthy individuals in Germany or in Poland, without any necessity of another approval of the local regulators or whatever. It's the same way as a technology company in Texas could be distributed in New Hampshire, Illinois, or Florida. We have to achieve the completely same situation. The situation when primary markets are purely local is impossible for the future. As you see, I'm really focusing on equity financing. I don't want to speak about bonds or derivatives in the moment. Of course, there are also interesting topics to discuss, but that's beyond this panel. What is important for building a capital markets union? We have to understand that there are still regional or local markets which have issuers who are maybe SMEs or slightly bigger than SMEs and are not so much interested to be serviced from some kind of center. It's no longer City of London, but from some other center. So we need local ecosystem and local markets to be prepared to guide, especially SMEs, to the markets. And then, as I said, the market should be accessible to all the citizens in the European Union. I think there is already a wide understanding for example, on the secondary market that Europe is relatively consolidated. Brokers from one country can easily access the exchanges in another country. That's not a big problem. I would say there is one exception, and again, it's quite a dense topic, which probably is not a topic of today's panel, but I have to mention it. And this is the indexes, and the indexes provided by the major index companies. If you look at map of Europe, you look at map of NATO, you look at map of OECD, you look at map of European Union, you see Europe. If you look at classification, country classification of the index companies, you see exactly the Warsaw Pact and the situation before 1989. It is ridiculous. After 30 years, the classification, country classification of many leading index companies still are following the split of the Europe we successfully abandoned 30 years ago. I think there have to be a pressure from the Commission that Europe is the same country or federation or whatever as the United States, and the index companies should look at the European markets as the just parts of single single investment area. To the second topic of the panel, which was the panel of the new technologies, and you just said that there are going to be three areas where you want to discuss. I have to say the exchanges, which I represent, we invest a lot into the new technologies. We run highly efficient, usually virtual IT systems. Most countries have dematerialized securities. Everything and all the information or the trading is flowing in the speeds of nanoseconds. So I would say we were doing a lot in bringing new technology in place. Our DNA is the seamless financial integration, and of course we face relatively complex regulatory landscapes. The problem of European Union is still partly heterogeneity of laws and rules. I just have to mention, for example, accounting. Again, me coming from the new European countries, I cannot understand why after 60 years of integration in Europe, we don't have a EU gap. In the US, there is a US gap and everybody accounting the same way. Now in Europe, we have a 27 accounting regimes, 27 solvency regimes, 27 corporate laws. It's a complication, especially when you're coming to the primary market. For the new technologies, I would say regulation needs to ensure the technology neutrality. This is a very important principle. That's why I'm completely a little bit doubtful of the technology-specific regulation, as for example, DLT pilot regime. Why DLT should be some kind of supreme technology? It actually, with the exception of cryptocurrencies, it didn't prove to be. And after billions spent over last 5 to 10 years, the results are pretty weak, I would say. Is that being abused, even this pilot regime? Well, I would say yes. Some are arguing for less transparency in the DLT regime, which I don't think is correct. The new regulation, I'm welcoming the new technology, but the regulations should react to the new services and new technologies with the easy answer: same business, same risk, same rules. So the principles should be applied equally, regardless of what the new technology is. And I understand that there are a couple of technologies which are maybe interesting. All these ultra low latency trading, which we developed, definitely cloud computing, definitely interesting. DLT, as I said, a little bit doubtful. What is around the corner is maybe quantum computing, which could change name of playground in Europe, because some institution could achieve quantum supremacy, and what will happen afterwards. So there are some technology questions and technology projects which are interesting to watch. But as I said, same business, same risk, same rules, and that's where I probably want to stop now. I think you are muted.
Sorry for that. Thank you very much, Peter, for that very clear statement. You were setting it up, broke the ice, which is always a bigger challenge than for others. Very good, and I'm sure we come back to some of your points later in follow-up initial statements or in the subsequent discussion. I would like then now to give the floor to the next speaker, or next panelist, which is Paul Klanczyk. Paul, the floor is yours.
Hello, can you hear me fine?
Very well.
Perfect, thank you. Thank you for the invitation. Obviously a very interesting topic that's also quite on the forefront of many of the companies that are operating in this space. Maybe a bit of an introduction from my side. I founded 8 years ago a fintech company in the digital asset space, Bitpanda, that focuses on providing services to the retail customers to really access the new asset class of digital assets much easier, and also make it really location independent, right? Each customer from us should have the same access to this new asset class, or however you want to classify it in Europe in the same way, right? And that's where we came from. Over time, we also increased our offering. We now also offer traditional asset classes, stocks, ETFs, indexes, etc., gold, precious metals, and so we are basically at the forefront of the new trends that are currently emerging, right? Where the general population is really taking matters in their own hands. They want to have an active say in how the money is deployed. They don't lean back, go to the bank advisor and tell them, invest the money for me. I don't even understand the products. So yeah, they want financial education. They want access. And currently there's a big stream of retail investors really taking back the control of their investments. But that really comes to a lot of problems that we as a company are currently seeing, right? It's especially this financial integration topic. If you are in a different country, you will face different regulation. Even though the regulation goes back to the same European directive, 27 countries in Europe implement it completely differently. And for us, this is not something that's only in crypto, right? It's in our investment products that we have. It's in all the steps that we see, right? This can be from KYC standards. This can be from proof of funds standards that we have to apply. And for us, this is right now we've reached the size where our company valuation is above 3 billion, and we are able to raise money and also profitable, and we can tackle those issues. But if you really want to be active in the space and you're a small company, and I think as a European Union, we really should focus on having new innovative like business models tested out, because they can yield to much bigger things in the future. It's basically impossible, right? You have to focus on a very small market. You have to apply to local regulation. And if you want to go international, it's a lot of money and a lot of time you have to spend to, yeah, somehow get there. And that's exactly what we did. We are, for example, with the AML5 directive, talking to all the countries in Europe. It's really hard. It's not standardized. People in the like the regulatory side, they oftentimes it's not even fully implemented in the countries, so they can't even respond to us or in a timely manner. So you have a lot of gold plating issues currently, which also yields to a regulatory arbitrage situation that is going on in Europe, where a few countries basically advertise that it's easier there to get certain licenses and apply them to Europe, for example, which also I think shouldn't be the case. It should be quite standardized. And the third thing is because nobody really has the same standard. Nobody really wants to control companies that are either in other European countries or even worse, outside of the European countries. And then that comes to some really, really weird situations where even securities and other products are offered in Europe from outside of Europe without any licenses. And currently, nobody really feels responsible. It's really, yeah, who should tackle that? And for the companies that really follow all the regulation and try to comply with everything, is a really frustrating topic currently. But that's more on the negative side. Also on the, I think that the current situation also has a lot of potential. We, especially on the technology side, as Peter said, you can do a lot of improvements with technology, but usually technology, or most technology, is just applied to have some fractional improvements. You're trying to get something smoother or easier or something in that regard. But every, like there's some technologies that have the potential to go basically deeper in what they can do, right? Not only make fractional improvements, but really change how things are done. And while I agree on most points with Peter, on the DLT side, for example, I think the potential, while not yet fully utilized, is there. And it's really the change from, there's always a middle, like counterparty in the middle that facilitates all the trades, that facilitates settlement and payments and everything. It's now the first time that technology could be used to do it without a centralized party. And sure, currently it's used mostly for cryptocurrencies and some other projects, but there's also a lot of money being invested in technology around like fully automated settlement and asset exchange platforms that really can offer an alternative towards centralization. And there, my ask would be in the direction of, I'm not advocating for having, because you're using a technology, making it easier to get licenses or to have any advantages. But what we need to be super careful of is to not make it harder, because it doesn't fit in the current rule set really well. And there, I think we need to really figure out how can we provide a situation where it's possible to try things out, to really deliver innovative products, and capture also the zeitgeist with people who want to take charge, who want to participate directly on markets, and where maybe traditional markets are currently not able to deliver that. And that's why there is a demand for those services, mostly by retail right now, but this could also change depending on how those retail customers are also talking to their institutional counterparties. So yeah, so this from that side. And yeah, I mean, one of the biggest points I have is we can talk about all the rules and financial integration, etc. If there's no enforcement of people who don't follow that and provide the services to the European Union, then it's I think a pretty moot point, because the people that are actually following it are punished and actually underperform the market, and the other guys from external are actually yeah, crushing the markets without especially in the new markets that are currently coming up. The traditional markets, it's less of a problem, obviously. All right, thank you.
Thank you very much, Mr. Klanczek. Very clear, and also clear in relation to the first speaker. You noted differences and agreements. Lots of things to be discussed later. Before we come to that, I would like now to give the floor to Brian Coughlin, who, just remember, who stepped in kindly now for Monique Goyens, who is here today.
Yes, good afternoon, everybody. Thank you, Peter, for having me on the panel, even on such short notice. So I am with the European Consumer Organization, and therefore I will speak from the consumer perspective on these issues. And from a consumer perspective, the integration of markets very much so comes in the form of digital exposure to goods and services from other member states. Therefore, much of what I am going to say is on the digitization of existing financial services, as well as the CMU in more general terms. Okay, I will start with the risks, and then hopefully towards the end I will bring it back around a bit with also mentioning the opportunities of these developments. So if you feel that I'm being overly critical of current developments, then please bear with it. I hope I will not end on such a note. Okay, so starting with the risks, as I said, traditional problems that we've already had on financial markets in retail banking have been exacerbated by digitization due to new forms of advertising and targeting. For example, social media has become a vehicle to promote high-risk investment products with the false promise of high returns. In particular, and I'm afraid I can't get around mentioning this, ESMA and IOPA have recently reminded the public in their campaign around crypto assets how easy it is to fall into scams and ill-advised investments, in particular unsuitable investments as well, seeing as the high volatility and uncertain true underlying value of many crypto assets at minimum put the long-term strategy behind it for consumers into question. Consumers are exposed more than ever to fraudulent practices, not just in the context I just previously mentioned. In times of economic uncertainty, it is not difficult to make a bad financial product look like a good opportunity. And many firms know that and take advantage of this situation. For example, we have seen a proliferation of buy now, pay later loans, which can lead to consumer over-indebtedness, often fully needlessly. Furthermore, while digitalization can mean consumers having access to more information, it can also lead to information overload and confusion in already very complex markets. With the increasing replacement of personal contacts by online chats, robo-advice, and virtual simulations, consumers find it more and more difficult to understand the implications of their financial decisions, or that they are even making financial decisions in the first place, significant ones like taking up a loan in a buy now, pay later scheme. And here we should not underestimate the risk that comes from financial exclusion in this way, through the complexity that cannot be handled by many for reasons of age, for example, or education. And if that was not all, in addition, banks and big tech companies often struggle over the control of their clients' data under the premise that it is necessary to innovate and bring new services to consumers. Part of this is true, but consumers want a reliable service in which their savings are safe, responsibly handled, and that the insurer responds, for example, to their needs and expectations, without hiding themselves between inaccessible platforms that make it harder for consumers to find a contact point, or exclusion clauses in responsibility. So this may all sound very negative, but we have some data on this actually. For example, even though the UK is no longer a member of the European Union, we do have a member organization, consumer organization there. And Citizens Advice has shown that consumers got very easily into debt when using the buy now, pay later products, and that fully 41% of those who took the offers struggle to make repayments later. On the other hand, these developments can be a gateway for access as well. So, for example, the open finance and open banking offers and opportunities we are seeing for consumers can allow them to access new services by allowing third parties to access consumers' financial data without savings accounts, insurance policies, mortgages, investments, and so forth from the consumer. But we need adequate safeguards here to ensure that only financially relevant data is shared and not personally sensitive data. For example, the destination of a payment, which can be a religious institution, a doctor, particularly specialists can be revealing here, or a political organization. The principles of the GDPR, such as data minimization, need to be properly implemented here to avoid extensive consumer profiling, which is particularly virulent with financial data, obviously. Comparison tools are another benefit that we're seeing, which is also helping integrate European markets because it offers the opportunity to compare products from providers that consumers would not be aware of because they're in a different member state. However, this branch is also a prime example of having digitized problems that were pre-existent. For example, comparison websites often do not rate products in the interest of the consumer by quality, but instead of based on inducements, which leads the consumer to purchase products that are not in their interest. We have seen this problem before. Having transferred it to a new shape does not solve it. In fact, it only worsens it. Then I would like to mention one element which is essential to financial integration in the EU, and that is enforcement. You have already heard of it before today. In the aftermath of the financial crisis, the EU has led to efforts on banking supervision to avoid future stability problems. This is, of course, something to be welcomed, but we cannot forget that when it comes to digitalized financial markets, new challenges emerge regarding new data practices, advertising, selling of financial products, and so forth. This implies that there are problems arising. If there are problems arising in financial markets, there are different authorities now that are competent, such as consumer and data protection bodies. This requires coordination. It didn't in the past. The recently adopted EBA regulation mandates the creation of a committee on consumer protection and financial innovation. This is a very promising model, and we would like to see all these emerging practices, and most importantly that of enforcement actions taken that when consumers are harmed by misleading and unfair practices, to be coordinated in this way and then rolled out throughout the Union. What we have heard previously on regulatory arbitrage is not just a problem for providers of products, but for consumers as well, who cannot rely on the same level of protection, even in offers that seem fully equivalent because they are based in different member states. For example, we are seeing this with crowdfunding, where platforms are right now in a transition period where they can adhere either to national legislation or to the European level one. And the consumer protection levels of these can be vastly different, both between the national levels which are being phased out and the national levels and the European level. And this is a problem. It is not just a problem for the lower protection levels, it is also a problem for being uncertain what levels apply in the first place, as this is not clear to consumers very often. Okay. Yes, so the plaidoyer is we need single rules for a single market. We cannot have regulatory differences in digitized financial markets, because these markets are without borders, and so the rules must be too. Thank you.
Thank you very much. And I note if there is one, there are several red lines so far through the presentation. One, of course, is noting that the single market in Europe, in particular that relevant finance, has still many big holes. We are quite acutely aware of it, and I think it would take a separate session to discuss why in some of the specific areas, accounting, insolvency, tax, the situation is as it is. But of course, this is an important input, and I understand so the questions I asked you to ponder. So I would now, but however, I'll give the floor directly to our next panelist, which is Leonardo Gambocorta from the BIS.
Thanks, Peter, and thanks to the organizer for the invitation to this panel. I hope the audio is good, and I would like to share my screen to share with you some slides. Thanks for allowing me this. Okay. Okay, I hope that you can see my screen. So for me, it's a great pleasure to join the discussion on financial integration in Europe, and in particular, whether a decentralized European financial sector could achieve a more financially integrated market for financial service. I think this is a very important topic. So my kickoff intervention today is on the opportunities and challenges of decentralized finance for future financial markets. I'm taking a general approach on the tech side here to analyze what are the opportunities and challenges of DeFi. I will use some preliminary results of work that is currently going on at the BIS. For those of you who are interested in this work, you can contact me bilaterally, and the usual disclaimer applies. So we live in days in which advancing technology have opened new possibilities to improve the current monetary and financial system. There are new technologies such as distributed ledger technology and smart contracts that could help to achieve a digital monetary system characterized by low transaction costs, rapid settlement, and inclusive and open access. Such a system could provide a wide range of financial services beyond payments. It could provide more efficient services in lending activity, trading, asset management, and also in the insurance market. And of course, we should reach these improvements while preserving safety and integrity. We need, in a way, to shape a future digital monetary system that not only reach more efficiency on one side, but also other policy goals such as financial stability, consumer protection, as just mentioned, market integrity, fair competition, and financial inclusion. The proponents of decentralized finance envision a digital monetary system characterized by two elements that are decentralization and anonymity. To say in other words, we don't need the banks but banking, and at the same time, contracts can be anonymous. So at the moment, the DeFi's world builds on permissionless DLT together with cryptocurrencies and smart contracts. In principle, I think that decentralized finance is a good thing by obviating the need of centralized intermediaries or public infrastructure. DeFi is supposed to achieve faster transaction, lower costs, and open access. However, this is not what DeFi are currently reaching today. So my intervention today is about the fact that while in reality DeFi, decentralized finance, could be very important for financial inclusion, as it stands now, it fails to deliver on these promises and introduce serious risk. I'll show you that the DeFi system cannot harness completely the network effects, and it is prone to congestion, leading validators to extract high rents. All this means that DeFi growth is hence reliant on the influx of new users attracted by the rising price of cryptocurrencies. I think that we should adapt DeFi to make it a real tool for inclusion. Let me elaborate on fragmentation and congestion. We know that in a network economy, there is a natural tendency for network effects to kick in, which is to say, the more people use that platform, the more is my incentive to use that platform as well. There is a sort of a winner takes all effect. So what is interesting is that this network effect and the winner takes all effect does not hold for DeFi, and instead what we are seeing is an increasing fragmentation of the DeFi blockchain platform as it is seen in this graph. This is the percentage of the asset log that is a sort of a collateral in level 1 and level 2 network blockchains. In the recent past, this was dominated by Ethereum platform that is represented by the blue area. But what it is happened, especially in the last years, is that the new level 1 network have entered into the scene and they have increasingly established a footprint. So the question is how this can happen in the presence of network effect. One way to respond to this question is to see what is the cost of using one of these blockchain platforms, and in particular, if we look at the gas fees. So for those of you that are not familiar with this term, the gas fees is a compensation for validators to perform their task and report truthfully. The compensation increases exponentially with the increase in transaction in the platform. Another way to see this is that the alternative chains have risen in coincidence of the rising in the gas fees. In this graph, you can see the spikes in the Ethereum gas fees that are very high from mid-2020, and this is the symptom of the scalability problem. At the same time, there are other level 1 network taking market share from Ethereum, and the number of protocols increases from 2020. The slide represents the major blockchains, excluding Ethereum. When there is a spike in the gas fee for Ethereum, that is the blue line, we see alternative level 1 network attracting more protocols that are the tokens. So from congestion in Ethereum, other blockchains take a larger footprint. So this highlights the Vitalik-Buterin trilemma. This can be represented by a triangle between three features. One is a decentralization. That is, in principle, we don't want a system that is dependent on a small number of agents. The other one is security. That is, the history of transaction is accurately recorded. And the third one is scalability. So we can reach the socially optimal volume of trade via network effect. So in other words, the scalability is going to suffer because the consensus protocol is going to use more and more and render the DeFi system not scalable. There is therefore a technical issue which has to be solved. So is DeFi the only game in town? Well, we can look at the evolution of more traditional forms of conventional payment system. We see something that is in great contrast with the DeFi experience. In the conventional system, we do see this network effect that gives rise to greater use, and this gives rise to more activity, and this gives rise to even more users to the platform. And we represent a chart of a recent BIS bulletin that we have published a few days ago on the instant payment system in Brazil that's called PIX. So this is a system was very recent. It was launched at the end of 2020, and it is now operational for a little bit more than a year. And in this period, it has been used by 2/3 of the Brazilian adult population and 60% of firms. This is an incredible expansion. And of the 114 million individuals that use it, 50 million of PIX users did not use bank transfer before PIX was launched. So this is a story of financial inclusion. It is free to individuals and it's free to the merchants, unlike credit debit cards, and they have we see high merchant fees. And what is happening is that the use of PIX is now overtaking the use of debit and credit card in Brazil. So the question is, could DeFi emulate something like this? So another aspect to analyze is that the DeFi system is sustained by coins. And when the price of a coin goes up, the price of another coin goes also up. This is a simple chart reporting average simple pairwise correlation of the coins used in each blockchain. We see that these are all positive and give us a sense of the excitement that there are in the DeFi universe. The more this ecosystem gathers pace and the more enthusiasm this generates. This system is very much linked to the coin price. So it is, for example, very noticeable that institutional investors are playing a much bigger role in crypto markets. This is just the trading volume of Coinbase, an important cryptocurrency exchange, which raises another question that is very important. To which extent DeFi is sustained only by the inflows of new investors, the new holders of coins in the crypto market? What if the system becomes mature and this new flow of investors slows down? So in this chart, the black line is the year on year price change of Ether, and the pink bars are the new DeFi unique addresses. It's a number of private keys in terms of all the platform, and the enthusiasm seems sustained by the raise in the price of coin. And here, the very important question is DeFi mature enough that the system will is well sustaining even when the price of the coin stabilizes? Does it need increasing price, or it's going to evolve even if the price stabilizes? And another question is how decentralized is DeFi? So Bitcoin is closest in the spirit of DeFi, and this is why its protocol was developed around a proof of work. So proof of work is less sustainable as it requires a lot of energy to be used. So we move to a proof of stake. A proof of stake reduces the number of complex computation. Instead, the power to validate the transaction goes to those with the most holdings of the network's native currency. As we moved to the proof of stake, the insiders have a larger stake in the coin themselves. And you can see this from this graph that shows how much of the initial coin allocation is in the hands of the insiders that regulate the proof of stake mechanism. We are in the danger to move into a situation in which the insiders have a very high stake and they are the only one who actually collects the rents. And when the validators win the right to update by attaching a new block, of course, it is up to the validator to see what orders there are in. And of course, the validators can benefit from knowing what the trades are. And this is what is called the miner extractable value. So how much resources you can actually extract from your right to append the latest block. And this generates high profit. So despite the fact that DeFi is decentralized, we have a lot of concentration of rents. So let me sum up. So decentralized finance offers a range of new financial applications as part of a broader vision called the Web3, often built on anonymous distributed ledger. The principle of automating transaction and reducing the reliance on intermediaries is a very good principle because it can bring down costs and we can achieve a more diverse financial system. But at the moment, DeFi is not delivering this in practice. So DeFi must incentivize validators through high fees, rents. This not only implies high transaction costs, but this determines also concentration of wealth and power in the hands of a few insiders. And we have seen that this keeps transaction volume low. Thus, the blockchain application do not scale up as they cannot harness the network effect essentially to money. So it is inherently the more the sorrier, not the more the merrier. And this gives rise to fragmentation of the DeFi landscape and prohibits the widespread use of the blockchain-based assets for the real world application, especially in advanced economies. So in a nutshell, DeFi and automatized smart contract do not fully replace for trust. And we need regulation to let the technology to produce the expected increase in efficiency, addressing at the same time the relevant risk. So regulation of crypto assets, stable coins, and DeFi is urgently needed to address severe risk for financial stability, consumer protection, and market integrity. So we don't need only efficient financial markets, but also safe financial markets. Thanks a lot, and I'll pass the baton to the moderator for the next panelist.
Thanks a lot, Leonardo, for your very clear expose. And then I would like just to hand over the floor to our last panelist in this initial round, that is Magdalena Borovic. Magdalena, please.
Good afternoon, everyone. It's an honor to be here and to speak on the panel on the meaning of technology for financial integration. Listening to the previous presentations, I believe that my slides will fit in because I can agree with all the speakers before me. When I was getting ready my slides, I pondered, what is actually technology? Can we please, next slide? Thank you. So what is actually technology? I'm a policymaker with 20 years spent in information technology and 10 years in financial technologies, financial services industry. So what is actually technology? And today, it seems to me like technology is it could be really everything. It is everywhere. It does almost everything. It permeates organizational structures and also human lives. So in order to come up with answers, what kind of technologies we should consider meaningful for financial integration, I decided to go with themes in technology instead of specific computing techniques. So given this, today we've got a lot of buzz in financial services industry, particularly in last 2 years during COVID. There is a lot of media attention for new new activities to the markets. It's like meme stocks, very high volume trading of retail investors who supposedly have taken their futures in their own hands. Well, I'm old enough to remember that, for example, subprime mortgages were marketed as the democratization of finance and a way for the little guy to finally own a house. There is the metaverse and Web3 narrative, which in my opinion is mostly the gig economy 2.0, mostly digital multi-level marketing schemes. And also from the technology perspective, is like blockchains are slow expensive compared to decentralized solutions, and pseudonymous. And over a couple of decades, we've been trying to fight anonymity in finance for AML and CFT purposes. And we are right now during the crisis in Ukraine and the Ukraine war, we still have issues with beneficial ownership and anonymous shell companies, and like supposedly decentralized finance offer this anonymity. Do we really need this? There is also the whole DeFi, stable coins and NFTs, like from Bloomberg article today. It's reported that 95% on one of the biggest NFT marketplace is actually wash trading, so people selling the NFTs to themselves. And also CBDCs, like a very hot topic in central banking. Last year, I believe it was last year, one of the Fed governors, Mr. Quarles, described them as parachute funds for central banking, that it is a solution in a desperate search for a problem, particularly in markets like Polish. I mean, I'm from Poland, I live in Warsaw, and our payment infrastructure has been like electronized, computerized for like 2 decades now. And the payments, or the Brazil example, PIX is, these payments solutions are there and are effective. So my question was, okay, this is the topics we've got today, but are they really meaningful? Can we go to the next slide, please? And just for reference, I listed the objectives or the goals for financial integration. So service passporting and accessibility, information sharing, knowledge sharing, of course, customer protection, governance of markets, and also risk sharing, particularly right now in the Ukraine invasion, the Russia's invasion of Ukraine, and the shocks, economic shocks stemming from that. So is like all that new tech, new buzz really meaningful? And well, in my opinion, the meaningful themes in tech are much more boring. This is one of my remarks, that my technology is boring. I'm from the infrastructure world, and the infrastructure is the thing that doesn't do anything, but it enables everything else to be done. And meaningful themes in tech for financial services industry, but even broader, and considering financial integration, are, first of all, it's digital identity and all the solutions around that. As identity is the new money, and we've started already using this new money on social media platforms, yet sometimes we don't even notice it. For digital identity, a user experience, particularly in financial services industry, is absolute key. Consumers, customers do want really, really smooth experience, and digital identity solutions can really help in that. Then we've got another important topic for financial services industry and integration. It's machine intelligence. And a lot of words have been said around this topic, and it is being perceived as maybe not the safest thing in finance. For example, in DeFi, there is this notion of autonomous transactions, autonomous finance. Do we really need that? So from financial integration perspective, what we should care about is that technology won't save us. So maybe not let it destroy us more than we are today, but machine learning can help financial institutions as they are modern data banks. So machine intelligence, if properly regulated, can be a boon for financial markets and integration. Another big topic and meaningful one is cloud. I'm one of the authors of cloud guidelines for Polish financial sector, And I know how much importance this topic holds for financial institutions. It is so much more than just other people's computer. It can enable very, very agile provision of services. And especially when time to market, we consider time to market, it is absolute king. So agile software development can help, and cloud is absolutely necessary for that. And so cloud can be good, but cloud technology is neutral. So that it can also bring risks, and opening up for cloud is great for the financial services industry, but it has to be done in a very reasonable way and in a safe way to protect the sector and market participants and consumers, and also the regulatory authorities from risks stemming from cybersecurity threats. And cybersecurity is the topic that is very close to my heart, as it requires public-private partnership, strengthen PPP, on information sharing, incident response, effective threat management, the disclosure, I would say. Threat disclosure has been problematic in the cybersecurity world, and in financial sector is probably even more shameful. So we need to work on that, how to make that disclosure easier for the integrity of markets and for the safety of all of us. And also, I'd like to point to a concept which is called cybersecurity by design, as data security is king. And cybersecurity by design is embedding cybersecurity requirements and regulations in innovations. When we build up new innovative startups, we should keep in mind that embedding cybersecurity is key in a very early stage, because regulatory compliance after the innovation is done can be very costly and sometimes turns out impossible. One of the great examples of cybersecurity by design is a great project of our Israeli colleagues from the Israeli Ministry of Finance. It is called the National FinTech Innovation Lab. It is based in Beersheba, and I recommend everyone to take a look on that because it's just great. It's public-private partnership, and it works just beautifully. So my point is that we should take a deeper look on infrastructure things, because they are really important for financial services and their integration. The next slide, please. And I'd like, because my background is I spent last 3 years in financial regulation and supervision. Further, I worked for Ministry of Digital Affairs, which is an institution that regulates digital markets in my country. So just very, very quickly on regulatory implications. So I'd like to, because that's a great opportunity to make a point about risk-based approach. As we are discussing today the financial integration, and to me, financial integration is the same access, the same rules and accessibility. And of course, our legal systems, the legal system of member countries are not the same. Legal acts can't be exactly identical everywhere. But what we can do, we can create policies that are risk-based. And as Peter said, the same business, same rules, same regulation. And what we need for new technologies probably more is not new regulations, but maybe enforcement of existing rules. So this risk-based approach, it's like a very good point to make. Capital markets are often regulated from that principle. In my country, rule-based approach, the traditional one, is still there, and it's very, very difficult to simply create something in a different way. So the next theme in regulatory space is the RegTech, regulatory technology, and supervisory technology areas, which are mostly combining all important infrastructure technology in one. And they offer new ways to engage with regulatory authorities via APIs, for example. They provide compliance cost optimization for market participants, and they are proactive. If they are implemented properly, they can use, for example, advanced analytics and provide supervisory authorities with insight on what is bound to happen, for example. So this toolbox for regulatory institutions, it needs updating. And for example, it was really great to watch the presentation of Leonardo on DeFi. And sometimes when I watch the space, my feeling is that sometimes we seem, as regulators, seem not to distinguish zero-sum games or even negative-sum games that are digital and are digital native. And maybe we should come up with something, I don't know, maybe a tool for zero-sum game assessment online, I don't know. So what I'm trying to say is that the regulatory toolbox has to get updated, because outdated policies, they give markets, market participants, consumers, and authorities false sense of security. And also I would like to point, because now everyone's talking about Web3, and I'm sticking to Web 1, so humans. And customer protection is absolutely key for building trust. Capital markets and financial infrastructure are public utilities of trust. So we should do anything to protect them, to build that trust. The source of trust is, of course, humans, Web 1, so to say. But technology is there, and the technology can help building, improving trust in public infrastructures. But technology, to be really effective, needs an integrated, responsible approach to development via cross-border demand-side innovation ecosystem around customer due diligence, so digital identity. And my next slide, please, this is the last one. Given this opportunity, I'd like to share my remark about linking innovation to national security, particularly in the coming time of uncertainty. And the EU, in my opinion, in my view, has some role to make some improvements. Let's talk about digital sovereignty. Let's talk about semiconductors, connectivity, digital identity, and financial systems put on top. Maybe it will be worth considering a better alignment of interests. I mean, national security interests and private sector interests. They, in my opinion, need more alignment. Of course, education. So ecosystem-based approach to achieve more decentralized financial services, financial markets union. So not only City of London, but more cities taking this role in more decentralized manner. So we need education. We need to approach markets with this ecosystem-based thinking to systemic innovation management, because it needs more attention. I have done one of my projects in the past was the design of a Polish fintech ecosystem together with the University of Cambridge. And I can share that we really struggled with this ecosystem-based approach, because no one seemed to understand the importance of it. So there is education to be done. And last but not least, the investment, because financial innovation is the mother of all innovations, as it enables funding of activities that turn research into products. So in order to achieve more integrated financial services industry, we simply need to agree what is important, what is meaningful in technology dimension, of course, and then proceed with that in an integrated systemic manner. And I'll stop here. Thank you.
Thank you very much, Magdalena. Thank you very much to all of you. I would now, at this point, remind the audience of the possibility to raise questions. Now, if you intend to do so, don't wait too long. It's 3:15. The expiry date of our panel is coming relatively soon. While panel might ponder about, while audience might ponder about questions or not, let me perhaps start the discussion. And I mean, I heard now a lot of questioning of DeFi in general, DeFi, the contribution to financial integration, risks. Let me get a better handle of that. I will now throw at the panelists 5 questions. And feel free, all of you, to answer between 0 and 5 questions, completely as you wish. Let me start then with the first question. I heard a lot about stability and risk aspect of these. What did I hear? I heard, for example, cybersecurity risk. Yes, but this is, of course, genuine to all, also traditional financial systems. So what is the genuine additional risk of DeFi? Is it just the individual investor's risk, which might be more elevated? What are we talking about? Secondly, my second question would be, is it useful or not to distinguish when we approach the theme, when we look at the possible contribution of DeFi, between its current state, a young, relatively young child still, rough edges, or should we also like factor in a possible later, more steady state version of it, which might also sort of like readdress some of the governance issues, which were, for example, raised by our BIS colleagues. Fourth, of course, also because we commission work on it, ECB works on it, central bank digital currency. Maybe 1 or 2 words on that. Magdalena just noted at the end that this is a solution to a non-existing problem. Is that so? And which problem exactly is non-existing? And finally, fifth and last, on regulation. I mean, yes, okay, some mentioned there is a regulatory gap, but what exactly? And if you, I mean, with all, I have to be very cautious because the Commission proposal is just a proposal, but if you sort of like consider your statements against the background of our MiCA proposal, what are the current major remaining regulatory gaps? So this is just a menu of possible questions. If you find all these questions stupid or boring, then please feel also free to react directly to what some of your co-panelists said. Please, the floor is for panelists up for grab.
If you wish, I can start saying something on central bank digital currency because of the work that the BIS is currently doing on this topic. So let's say that decentralized technologies can be used to support, say, public goods, for example, through the global network of the central bank digital currencies with the multiple central banks. Here we have 2 kinds of central bank digital currencies, wholesale and retail. So wholesale central bank digital currency could support new functions in financial services, while retail central bank digital currencies and face payment system can help lower the cost and support financial inclusion. So these are the goals that they want to achieve. And I can see that many central banks are considering the potential of central bank digital currencies to support cross-border payments. So the BIS Innovation Hub is working on a number of projects for so-called multi central bank digital currency arrangements where multiple central banks work together and make their central bank digital currencies interoperable, either by harmonizing the standards, interlinking the systems, or using one joint system. That is also possible. So indeed, if compared to today's corresponding banking arrangement, a multi-central bank digital currency arrangement could offer a much simpler monetary architecture for the cross-border payments. So the retail users would interact with a payment service provider, which is in turn connected to the central bank, and the foreign exchange conversion would still be needed in the foreign exchange markets, but there would be far fewer steps in the payment chain than in today's world, and this could reduce costs and increase speed and transparency. So the EU already has good experience with a single European payment area and fast payment, which has reduced costs and increased the speed quite a lot. A central bank digital currency would in some way just build further on this success. And importantly, depending on the design, a central bank digital currency system could enforce interoperability between bank and non-bank payment service provider, which would give users more choice. It could also be built to ensure greater privacy and user control over the data. It could offer new functions, such as programmability as smart contracts, maybe differently from the DeFi. Finally, would offer very high safety as in the form of a central bank management. So there is ongoing research on central bank design to achieve this goal at the BIS. I think the jury is still out on which solution is the best for each jurisdiction, but there are definitely new opportunities that central banks are actively exploring. Stop here.
Thank you very much. Then I was made aware that there is one question from the audience. Mr. Martin Schmalzried, please, could you address your question? Please, question and reply probably have to be rather succinct given the advanced time. We cannot hear you. No? Mr. Schmalzried, I cannot hear you. I assume it's not just me. I can see your lips moving. Yes, maybe would you be able to type in your question if it's
okay. Yeah.
now I hear you.
I'll do that.
No.
Great.
Just when you say it, I hear you.
Okay, great. So yeah, just wanted to react about the Web3. So I like to quote Heraclitus here. There is only one constant in life, which is change. And so I'm sure we'd like to freeze sometimes our reality, but the hard truth is that everything changes, including what we think will stay forever. Now, I had a question to Leonardo especially, but feel free other people to react. Did you consider the implications of using crypto assets as a means of payments in parallel to the euro, for instance? Because crypto assets are created in a completely different way from the way money is created in our debt-based system. So if they become means of payment, it could amount to a multiplication of the monetary mass. For instance, if I buy 1,000 euros to a European miner to buy his minted or mined crypto assets, the miner has my 1,000 euros and can spend them into the economy, but I also have 1,000 euros worth of crypto assets, which I can also spend into the economy, contrary to buying like a painting or a phone. I can't pay with those. And then a more general question is, the conference title was about financial integration. Do you believe that the financial system as it exists today can integrate the emergence of public blockchains? Sometimes I wonder if we're talking about like the integration of fax technology with email and the internet. It's just not integratable. So thanks, that would be to my questions.
Very good. I mean, as Leonardo just spoke, I mean, I want to, if you give him some rest, and ask other panelists if you feel like you would like to reply. Otherwise, it falls by default back onto Leonardo.
So maybe I'll try quickly address that. With regard to CBDCs, I was talking about retail ones because wholesale CBDCs, I believe, already have existed, and central bank reserves are, issued electronically. So one can argue that wholesale CBDCs already exist. With regard to public blockchains, I've been watching the crypto coin space for 10 years now. I also have designed the first DLT sandbox in my country. So you can consider me involved in the crypto coin community for a very long time. And this decentralization, the centralized blockchains, they don't fit existing regulatory regime and legal systems. They don't fit for a purpose because they were designed with their primary design objective was to avoid regulation. So it is extremely difficult to answer this question. How are we supposed to integrate something which was designed not to be capable of integrating? Also, the decentralization is sometimes used as an excuse in Web3. So there are projects that seem to, that they communicate that decentralized, but in fact they are not. So there is no single definition of what decentralization really means. It can be considered on various levels. It could be political, it could be logical, it could be architectural. In the capital market context, it could be the lack of like centralized place where the trade happens. So there is no definition, there is no approach. We don't have any definition of that, and including some kind of decentralized vague decentralized elements to our regulation doesn't make a lot of sense, in my opinion. And I'll stop with that.
If I can react on it, it's Peter from Prague and from FESA. And now I'm speaking with a cap of my Prague Stock Exchange function, not really for FESA. I've been in the last 5 years visited by tens, hundreds of, visited tens, but approached hundreds of the crypto world people, I would say. Many of them were very optimistic, since the opening of the doors. They were always saying that they are changing the world, that they are bringing the new future and blah, blah, blah. After half an hour of discussion, in a 99.99% case, we found that the whole project is regulatory arbitrage. They are simply using the crypto world because it's less educated, less regulated. Well, it's educated mostly as well, but less regulated than the normal world. And now I'm not protecting the regulation. I'm really mad sometimes with the regulation. I'm mad, that the people who wanted to buy simple shares or simple bonds of our SMEs have to fill in the questionnaire of 30 pages. I think are totally overregulated, the market, especially for retail purchasing the securities on our market, totally overregulated. And we need to really skip many of those regulations, that there is no need to regulate purchase of the SME for rich individuals, and don't regulate at all that he's going to buy to the auction and painting of a questionable value. He's going to bet on the results of the football. There we don't regulate him at all. But when he wants to invest 1,000 euro in the stock exchange traded stocks, which are highly described and how regulated itself, then you have to fill in the 20 pages of the questionnaire. So overregulated completely. But it is valid fact, we are fighting against it. We are arguing against it. And the pure fact that somebody's coming to me and saying like, oh, our technology is now right here. It's actually based on crypto. And you all dinosaurs are so stupid that you cannot get it. And we will now get all these things to the general public without any regulation, without any of your stupid questionnaires. And they will invest zillions and we will change the world. And I usually throw these people out. It's like, I know it, that it would somehow work if you obey some kind of regulation. That would be easier for you. But unfortunately, we are here with official license and we have to follow the law, although we don't like it sometimes.
And I think that might be a good
Thank you
note.
Yes, please. I just wanted to say, Brian and Paul, as we have to come to an end, I would invite you to take the floor and answer that question or react on anything else. And then we have to, sadly, already envisage the end of this panel.
Yeah, maybe just very quickly, sure, there's a lot of trash companies around, so let's not focus on that, but maybe the regulated ones. But in this discussion today, I feel like there's, especially the question that you raised, Peter, are we talking about the current state or are we talking about the future state of what it could become? And it's like saying there will never be the option to stream 4K over the internet, right? And the discussion is in 1995 or something, right? So you have to look at what is the potential before saying, yeah, it can never become a DeFi system that can scale, right? And I think most of the points today can be summarized that this is a evolving technology. The technology in 3 years will have completely different attributes than they have today. And I think this is something that we should acknowledge, and also regulation shouldn't hinder, right? And also on the other things you raised, right? I don't think that crypto should be able to circumvent anything. I think it should be the exact opposite. The regulation gap right now exists in there's countries where there's regulatory arbitrage possible, but on the other hand, there's a lot of companies outside of Europe just ignoring the regulation, and they still offer the service in Europe, and that's a much bigger problem than saying that the crypto, or even the basic discussion, right? That what's currently possible, what's currently not possible. So I would say let's focus on what's here today, the issues that are here today, and let's try to not hinder any developments in the future, because I think we are still super early on with this technology, and the capabilities will never be less, they can only go up, right? It doesn't mean that everything can be solved with this technology, 100% not. I don't think anybody is saying that, but certain parts will be solvable, and they can only be improved every year.
Thank you very much. And last but not least, Brian, I can promise you one thing. On this panel, at least nobody will be able to contradict you anymore. What you say, whatever now.
So that sounds like I should be making some wild claims, right? No, I'll stick fairly close to my own script. So the thing is, I agree that we need to focus on the here and now. Whatever might be coming up in a few years, we can cross that bridge when we get there. But for now, we have a massive problem, particularly with crypto assets on retail markets, because pure junk is being sold to consumers aggressively to significant damage. And that is something we must do something about. Particularly, we need to enforce against it from the supervisory authorities, both the NCAs and the European level ones, ESMA, IOPA, and so forth, on the basis of, for example, false advertisement, which is already something that can be done here. But maybe we also need regulation in particular to this to curb the damage right now. And I don't think that a proper ecosystem can develop on a basis that is so thoroughly tainted with fraudulent activity right now. So if it is to grow and if it is to develop, we need to fix this issue so that it then can then evolve into maybe something more useful if it does, or maybe it doesn't. Either is fine with me. But it won't happen without enforcing against fraud right now. There was a question, by the way, about inflation. I don't think that's a major issue. The potential leverage that banks can do is almost unlimited. I think I don't need to explain that, seeing as the ECB is part of the inviting party here, but I just wanted to mention that like bond issue functions very similarly, doesn't need this. Oh, and final remark, because Peter said that the retail market is over-regulated. I would say it is falsely regulated, not over-regulated. We have a incentive problem in the sale of financial products where the worst products get pushed to consumers aggressively through adverse selection in the advice process. And we have tried to fix this through transparency requirements. And now we have lots of transparency requirements and lots of missale. And this state of things is factually political battlefield debris between us trying to regulate the distribution of financial products in a way that makes sense by limiting false misincentives, and the attempt to do anything else. And so we get stacks of paper. That's how we got here. But that's not over-regulation. That's pseudo-regulation. Thank you.
Thank you very much, Brian. Thank you very much, all my dear panelists. It was a pleasure. It was an inspiration. I hope the audience can join in on that appreciation. Thanks for having embarked on this sturdy, difficult, not obvious theme. I'm sure that will not be the last time we talk about this, maybe not exactly this formation, but that somebody will have to further development and not least for regulatory purposes. I wish you all a very pleasant rest of the day and hand back the floor to the host, to the ECB. Thank you very much.
Thank you very much, Peter. Thank you very much, participants in this panel. It was interesting to listen to this debate. We now come to the last session or agenda item of today's conference. Jérôme Henry, Principal Advisor in the Director General Macro-Prudential Policy and Financial Stability, will share with us his take on the conference today, what he took along from the conference, the main messages. Jérôme, the floor is yours.
Thanks a lot, Philippe. Thanks a lot to all people in the virtual room. We had a rich debate today, also a very long day. So I must say I'm happy, not really sad to bring the event to a close. Still, please allow me to use the time I have for a few personal remarks before formally ending the meeting. First of all, apart from the few usual glitches, everything went fine and smoothly, although it was taking place in a very special environment again. In fact, 2 years ago, this very conference was the first ECB event that got cancelled. And then we had to hold it entirely remotely with then, I must say, a French paint feeling, but now it has become the norm, right? Also, back in 2020, remember, the Corona crisis has just started. It was just after the March turmoil on the financial market. And now in 2022, as the Corona epidemic is hopefully fading out, we now face a cruel war with also economic and financial effects. To date, via commodity trades, but it could go further using other channels. So both crises may have more lasting impacts. And are we in for another, say, 2 years? We'll see as time goes along. 2 years ago was also, in fact, a special event for the ECB, but for less dramatic reasons. It was the first time that we put financial integration and structure together in a single report. Incidentally, I then teamed up on that occasion with Philippe Hartmann, who has been, I have to say, the #1 character at the ECB in these events over the past years, and again this year. Let me add in this connection that the joint venture also resulted in a beefed up statistical annex, which is available today, covering indicators of integration, but also structural trends. Thanks very much to the DG Statistics colleagues for doing that. Indeed, when we look at it, financial integration and structure are closely linked and interact with each other. Let me quote two very simple basic examples for banks and non-banks, as it were. First, cross-border activities or M&As among banks boost banking union and therefore integration. Second, we have documented in our reports the increasing role of NBFI, non-bank financial institutions. Not sure it sounds much nicer than shadow banking, but that's the way you should call it. And this holds this increasing role for both funding and assets. And this implies cross-border diversification, which also supports this time capital market union. Actually, a red thread on these reports and conferences was fostering banking union and capital market union. There was even a topic about this being done top-down or bottom-up. I liked it very much, given my stress tester and modeler past, I must say. This event has anyhow a very rich track record across a wide range of topics, including regulation and infrastructure, always with a strong policy background. Just to recall a few things we talked about, how to strengthen equity markets, can fintech help with integration, how to harmonize insolvency rules across the EU, and finally, also another example, target to securities as a tool for integration. Okay, so much for the past now. How did we advance on such related areas today then? Let me say, before I start, rather than providing a detailed account of the debates, I will share with you what I think were the main takeaways of our various and varied session in a summary manner. I will do that also for the very last one, which is of course a bit challenging. So we started the day with our Vice President's speech. Two main ideas I would retain. First, the progress that was achieved on financial integration since the start of EMU has helped increase the resilience of the EU financial sector. This was achieved via greater integration of both prudential institutions, but also policies. And this has helped obviously face the pandemic crisis. Second, further deepening on EMU, delivering on CMU action plan and completing the banking union, again, the two same fellows, will help tackle current and future challenges. We've seen that financial integration helps absorb shock, but it also improves the EU ability to take action in a credible manner. We are seeing it now with the Russian-Ukraine war. We've seen EC and ECB reports which have been just published on the occasion. They were presented, I dare to say, they are the regular cornerstone of these events. Some key messages as I could interpret them, starting with the EC colleagues' work. First, following the COVID-19 pandemic, financial integration recovered substantially faster than after previous crises. Again, this was thanks to the prompt policy response EU-wide, but also to the positive effect of longer-term regulatory and institutional reforms, as just said. A caveat is that ongoing structural change post-crisis would require further monitoring. The second point would be that compared with traditional finance, decentralized finance has a strong potential, as it could increase, quote unquote, the list coming from the EC report, security, efficiency, transparency, accessibility, openness, and interoperability. Lots of advantages. Substantial opportunities to foster financial integration, but the whole thing is not risk-free. There's a need to balance innovation with risk mitigation. We'll come back to that with the second panel, in fact. For the ECB report now, next to the key role of policies during the corona crisis, which was stressed already in the Commission report and in our VP speech, let me add two more points which I think are worth taking home. First, during the crisis, NFCs adjusted their financing mix from trade credit and listed shares to bank loans and debt securities. But this implies that we have increases in debt, and the pandemic-induced private and public debt increases will remain with us for some time, and it's an issue to address. Second point from the ECB report, after the crisis, Next Generation EU provides the historical opportunity. An opportunity to better develop risk capital markets, especially for greening the economy. But there is a substantial additional private investment which is needed, because there is a gap between the size of the ambitious public programs and the public funding available. which actually connects quite nicely to our first panel, which precisely focused on the issue of private funding. The two messages I would take home on this first panel was first, that to bridge the US versus EU gap that exists, all the involved frameworks should become easier, but also stable, reducing uncertainty. Another point very much related was that the story is not all about money, it's also about people. So we need to manage to attract and keep talents. Finally, on that one, there was also the idea that there's a need for a complementarity between private and public funding, which was the very topic, but crowding out by public funding of private sector initiatives should be avoided. At the end of the day, I think a side element which can be quite important is that the public sector may they need to take stronger risk, to take the higher risk branch in the projects in a way. After which, it was time for Commissioner McGuinness to give her keynote speech, from which I would emphasize 2 points, both being made with a view to fostering financial integration. The first point would be to deepen CMU in line with the action point once again, and in particular addressing issues such as divergent rule within the EU, as well as responding to the need for a strong but balanced supervisory framework, meaning balancing between the need to have a centralized, harmonized framework and ensuring level playing field, for instance, vis-à-vis the outside, but also respecting national specificities. The second important point was that CMU does enable the EU single market to operate within a multi-centric financial system. And in particular for CCPs, that means combining a broader offer of services with incentives and obligations on the other side, that is for market participants. In any case, all stakeholders were invited to engage in the discussion. We finally discussed, as I already hinted to in our second panel, how decentralized finance could help increase EU financial integration. My first takeaway on this, it's a freshly debated issue, so you would admit that even more than for the other items, this is very provisional and challenging. But anyway, the first takeaway was that more integration via direct and simpler entry for retail users based on a bunch of new technologies would boost integration. But it would be counterbalanced by equally, so to say, a range of new risks for consumers, but also to financial stability, which altogether would likely call for an attuned new regulatory toolkit. Now, this is the second takeaway. Clearly, regulation needs to adapt, but it's not fully clear how this can be done. Regulation needs to cater for new risks, but still under the same business, same rule principle. But we heard first the plea not to discourage innovation, plus that a rule-based approach would be difficult to implement. Let me mention, however, to keep the positive aspects of it, that we were given the example of the harmonization of indices classification, which probably is a technical and directly useful step, relatively easy to implement. At the same time, if we talk about risk mitigation, the picture is much more complex and challenging. Okay, now that I've talked about past and present development, let me have a very quick look to the future. I will mention areas to possibly be investigating, but I should stress without any implication for anybody at this very early point, as we are in a very brand new reflection cycle. The first area I see worth exploring is the complex links between financial integration and development. We heard in this connection about the green bond paradox, with development possibly going against integration over time. But we understood also in the last session that decentralized finance is not all good and safe, to say the least. A second area where work could be done is derivative markets. And that's beyond for commodities, which is really the focus with the current war crisis. How to best weather common shocks Well, that calls for a financial and not only industrial response. And in particular, that would probably call for reviewing CCP's linkages, including with non-banks and non-financial corporates. Okay, I'm very close to the end now. I've done like the substantial part of the summary, quick summary of this heavy day. And before landing after the helicopter tour, I would like to warmly thank all colleagues who rendered this event possible. There is a long list of contributors. I hope they will forgive me for, again, not being exhaustive now. Just let me name a few. I will start with a particular mention first for Philippe Molitor, our master of ceremony today, but also behind the curtain over the last 2 years, at least at the ECB. Connected thanks also go to a bunch of ECB, DG Research and DG Communication colleagues. I would name in particular Raquel Gil Antona, Erika Ritting and Iris Meyer. Similarly, on the EC side, this is a joint event. The whole team was involved with very good connection with us, I must say, and in particular, Jungduk Lichtenberger and Cornelius Schmidt. Last but not least, our gratitude goes to speakers, obviously, and to the audience. You were very active today. I hope we can next time pat on the shoulders, have a follow-up chat, like in the good old days. So I would say have a safe trip home. Well, no, I think it's rather time now to close the session on your laptops. And I would say see you in Brussels, hopefully without another crisis and hopefully in person. So I would say goodbye and thank you to you all.